best app to use is the NDTV app.
Back with India market close right here on NDTV Profit. It's not raining as badly as it was yesterday, and maybe that's what the markets are celebrating as well, because I call it a celebration because we've come up from the lows of the day, and which is actually a really good sign. Now, Kush Bora has spoken about this, that it is a market that is buy on dips, or even this dip was something that he bought into, but he might be comfortable being constructive in the markets right now as well. Mr. Chokalingam joining in. Mr. Chokalingam, if that is the overarching view, for businesses that you like, are you putting in money to work right now, or are you waiting for a dip?
No, we are suggesting putting money. Even personally also we are investing. The only suggestion we are giving is that focus on domestic demand driven companies. Avoid companies which have export exposure to the US. Also avoid for time being adding anything fresh to IT services company. So this is our stand, and we remain quite optimistic on the market, even in the short term, because in the interest of the political scenario from US and on account of economic rationale, I believe ultimately US India would sign bilateral agreement successfully. That's my strong conviction.
Okay. Well, so we have two bulls on the show. Let's try and bring in a bear. If not a guess, then at least an argument. And Vansh Johnson to talk about the bull versus the bear argument for AU Small Finance Bank. Up, what, more than 3% today, Vansh? Why so?
Yes, thank you for that. So we have already seen a decent run up in the AU Small Finance Bank. So let me firstly start off with the bull case scenario. So now what we have seen is the bank has been the fastest growing bank. In fact, it has crossed the 1 lakh crore mark. 1 lakh crore loan book, and also it has shown a growth of over 18% on a year-on-year basis. Also, if I talk about the bear case scenario, now the growth has been falling due to the higher focus on the secured loan. The bank has been shifting its focus from the microfinance to the secured part. So this is what we are looking at in terms of the first case. Secondly, now what we are looking at is the decline in the margins. Now the margins may reverse in Q3 FY26 as the bank is anticipating revival in the credit cycle, and they may focus on lending a bit more on the microfinance part. However, the margins may fall sharply to 5.4% in the Q1 FY26, which is a bear case scenario as well. Moving on, let's also look at the credit cost. Now the credit costs are expected to improve from H2 FY26. Now the bank is expecting their credit cost to improve. However, in terms of bear case scenario, now the credit cost guidance has been hiked to 1%. Now the earlier this guidance was about 0.8 to 0.9%, which has been hiked to 1%, which can further have a significant impact on the ROA as well. Moving on, let's also look at the valuations. Now the bank is trading at a 40% discount to their 5-year average valuations. So this is a bull case scenario. In terms of the bear case scenario, now the asset quality and margins may remains a negative for this particular bank as well. Lastly, let's also look at the analyst recommendations. What we are seeing is a 16 buy calls, 10 hold calls, and a sell 8 calls with a analyst return potential about 8%. So this is how the overall picture is panning out for a AU Small Finance Bank.
Okay, Vansh, thank you so much for bringing us those details. Mr. Chokalingam, valuations are looking attractive, but asset quality is a concern for this particular counter. Your view?
I believe valuation is also not attractive. It's a great bank, no doubt about it. If you look at the last 5 years, one has to be very fair. The bank has done phenomenally well. But it is trading at around a 3.1 time price to book value. But fact is that in the last 2 years, the banking valuation multiples have contracted across the board. So I think it is fairly priced. I would recommend this stock only if it falls slightly below 700. Otherwise, 3.1 time price to book value is a fair valuation at current juncture for any bank like this kind of size.
Okay. 3.45%, 730 and counting. Is there a trade here, Kush Bora? Because the trade was when Somit spoke about this in what the dealing rooms were recommending at 705. It is at 730 now. Is it just starting or has it played its course from a trade perspective?
You have to hand it to Somit, right? What an entry point.
You seriously have to, yes.
You and I think, both are somewhat fans of Somit, right? With the kind.
Most certainly good.
No, definitely a good entry point. And in fact, that was exactly what my suggestion was going to be. 700 is a very strong support level for this. The stock has rebounded multiple times in the last 15 sessions from there. Also happens to be about that 38.2% retracement mark for that rally that started, in mid-March. So yes, it's got a couple of things going. So I would suggest positional trade on this one with a risk reward ratio of 1:2. 730 the current price, 700 strong support zone as a stop loss. 760 is the first resistance, and there's the gap around the 790 mark. So for a 1:2 risk reward ratio, but from a positional standpoint, 1 to 3 months out, you could consider a trade. Near term, there could be some resistances that might pop up. So yes, if you have a 1 to 3 month kind of a view, then you could consider a trade on AU Bank.
Okay, so that's a trade coming in with regards to AU Small Finance Bank, goes trading at the day's highest levels. Mr. Chokalingam, any view in terms of AU Small Finance Bank?
As I mentioned, it's good to hold for long term. So in case stock corrects anywhere around 670, 680, then fundamentally it becomes a little attractive.
Your view in the previous one, apologies for that, but the other space that is buzzing in trade today is the steel sector. In fact, JSW Steel, you have Tata Steel, all of them which are up in trade, and this is probably on the back of the anti-dumping duty that we're looking at against certain Chinese products. Vansh is with us to tell us more. Vansh, what is the news and what is the impact that the companies could see?
Well, yes, thank you for that. So we have clearly seen a series of developments for the entire pack, for the entire steel pack. Firstly, we saw the 3-year extension of the safeguard duty. We saw production cuts from the steel mills in China as well. And then we saw the Fed rate cuts. Now today, what we have seen is the DGTR has recommended anti-dumping duty on the Chinese electrical steel for the period of 5 years. Now, if I talk about the specifics, now duty will be imposed on cold-rolled, non-oriented electrical steel from China. And this particular steel has been, now the DGTR believes that this particular steel has been exported to India at a price below the normal value. And they believe that duty may range from a range of about $223 a ton to $414 a ton. Now they believe that this is on the back of this is to protect the domestic players from the cheap inbound shipments and to ensure the fair value for practices and a level playing field for the domestic producers as well. However, this is just a recommendation and the final decision for the imposing the same remains with the finance ministry. So this is what the overall picture is looking like for the entire steel pack as well.
Interesting. Thanks a lot for that, Vansh. And yes, I mean, you could almost argue that some of the companies and some of the sentiment around some of these steel businesses has been reasonably strong. I don't know if the second half slowdown in China or a perceived slowdown in China and world could actually dampen the sentiment, but else it's not been not buoyant, and which is actually a really good sign, right? I wonder if there's a trade here, Kush Bora, on the steel names that Vansh was talking about.
There is, my order of preference would be JSW Steel, Tata Steel, and then come in SAIL and Jindal Steel. But I would actually stick to the first two names because, while there is momentum in SAIL and Jindal Steel as well, they're close to their, technical medium-term resistance levels. So yes, if you want to consider, you could well consider JSW Steel as the first pick. I think from here on as well, there's good momentum, good volume action, which could take the stock to 1165 or even 1190 odd levels. Keep a positional stop around that 1125 mild resistance zone, which will now act as support zone. Even Tata Steel could inch towards 177, 181 kind of levels. And on the downside, 169, good support zone. So yes, my preferred picks would be JSW Steel followed by Tata Steel.
Okay, Mr. Chokalingam, in fact, the index itself is up almost 17 to 18% in 2025 so far. Do you think fundamentals will support a further upside from here on? Or would you say this would be then time to book profits?
I may be wrong, but I firmly believe that it is a time to book profit because, they are doing reasonably well because of the government support. But The steel is a global commodity, global metal, and there are signs of slowdown in China. And not only that, the most concerning issue is that the US tariff war, which is initiated against almost all major economies in the world and against all major imports going into US, is ultimately going to correct global growth. So there is no doubt about it. We will see some kind of deflationary signs. That's why even the steel prices are down on year basis. So I would rather pick up commodities or metals which are primarily driven by domestic demand. Not only that, even the prices are determined by the domestic equilibrium forces rather than the global forces. So what I mean is that I would prefer stocks like Coal India, which is isolated from the happenings in the world, because it sells coal prices much lower than the global prices. So instead of chasing the steel stock at current valuations.
Okay. All right. Now it's that time of the show which all of us wait for, where my colleague Soumit Sarkar joins us with all the chatter that he's hearing from the dealing room. Soumit, what are you hearing today?
Well, firstly, it's on JSW Energy. There are strong buy flows on FI desk is what dealers are indicating for this counter specifically. Apart from that, there is Hero Moto and Maruti. In fact, for auto space, what dealers have indicated is that they are seeing sell flows at higher levels on all the auto counters. Sell on rise is the strategy that they are saying that smart investors have adopted specifically for the auto counter. So keep an eye out for auto names, Hero Moto and Maruti. Apart from that, KFin Tech, that stock has been down yesterday on the back of a buzz that there would be a big block deal that would come in from the promoters. Now, post the first stake sale that happened in May 2025, everyone knew that the promoter is looking to exit. But the key question here is about the timing, and what I'm understanding from the dealers is the fact that there won't be any stake sale that will happen from the promoter's side in the September series. Most likely this deal will happen only post the second week of October. So keep an eye out for KFin Tech. For MCX, the stock has been gaining in trade, but there are some sell flows at higher levels, what dealers are indicating. And this is because the Q2 overall volume data is expected to be on the weaker side. Average daily turnover for futures and premium volume is expected to be down by around 6 to 7% on a sequential basis. For JB Motor, there are buy flows on large HNI desks. Dealers are expecting some positive development very soon here. And when it comes to BAC and Samvardhana Motherson, for BAC, multiple dealing rooms are giving sell calls on technical charts, and for Samvardhana Motherson, there are buy call given by multiple dealing rooms based on technical charts itself.
Okay. All right, Soumit, thank you so much for bringing us those details. I think the auto pack is in focus, and a lot of auto names also have shown up on that list.
Even I have a name, but first you go from that list.
But I think I'll take up the last name that he talked about, that is Samvardhana Motherson, because his recommendation, what he's hearing is that there is buy call given by a lot of these brokers. So Kush, technically, do you also think that it's supporting the charts right now and this is the time to make an entry?
Mahima, while yes, there is momentum, the stock at the high point of the day, there is volume action as well. But a lot of these names have already run up quite a bit. So I think it'll be a good idea to buy on decline. So if I were to look at that in an entry point for Samvardhana, I would be comfortable entering around 107, 108 levels. That was the resistance, the breakout zone. So any pullback towards those levels will make it more healthy. But if you have continued to hold with a trailing stop loss, fresh entries, like is the case with most of the manufacturers, the vehicle manufacturers, even some of these ancillary names makes more sense to enter at declines.
Okay, Kush Bora, there was a brief spike today in JSW Energy that we saw too. It's cooled off a little bit, but is it giving you a trading flavor, JSW Energy?
I think the volumes are giving me more comfort than the price action alone. The stocks actually gained quite a bit of ground, more than about 10-12% in the last month or so, month and a half or so. While yes, you're right that the stock is off the high point of the day, the volumes are still very interesting. Have been for the last 3 out of the 6 sessions, and the stock crossed the 200-day moving average as well, trading above the resistance of 540 mark. So, couple of things going for it. The mild concern here would be the momentum, and that is also reflected by the fact that it's off the high point of the day. But yes, there is there's definitely an uptick. Volume action does suggest that there is buying interest at lower levels. So if you have a position, continue to hold. If not, with a 200-day moving average support around the 530 mark, that acting as a stop loss, you could hold on to this one for higher levels of 570 and about 590.
Okay, so that's with regards to JSW Energy so far. But staying and coming back to the auto pack from here on, what's interesting is that Navratra has actually begun on a strong note for all your auto majors as well. And that is thanks to the big GST cut bonanza. If you see names like Maruti Suzuki, Tata Motors, all of them have already announced the kind of demand that they're seeing. Hyundai, you have M&M as well, which has joined the bandwagon so far. And that's with regards to what the auto pack is telling you. In fact, let me first take a quick question with Mr. Chokalingam in terms of the auto pack. Mr. Chokalingam, Bamba Navratri that has begun for all of the 4 passenger vehicle makers, and that's the commentary that has come in from them as well. What would you advise investors to do? Because in the month of September itself, you've seen a good run-up that has already happened. But from here on, where do you see them going?
Yeah, auto stock sector is a typical of what analysts learn about the stock market, discounting the future. As you rightly said, the GST reform was discounted much well in advance before our finance minister revealed them. I would rather suggest hold on to them, but wait for October sales, to see, because now there will be a pump up in sales because there has been a lot of delay expecting this GST rate cut. But one has to really see, post this one-time, ramp up in the sales, whether normal sales from October month, do they show any significant year-on-year growth, or they continue to show 2 to 4% single-digit volume growth. So till that clarity comes in, I would give hold, but I would give buy recommendation on tire stocks because they have got a multiple benefits apart from GST rate cut. The natural rubber prices as well as crude oil prices keep going down, and they are down more than 18-19%. And also the ramp up in automobile sales also positive. So therefore, one can selectively buy tire stocks and hold on to automobile stocks.
Okay, so that's the word coming in from Mr. Chokalingam. You could look at, automobile companies, but let's get across to Puneet to tell us more in terms of what he's picking up. Puneet, over to you.
Well, thank you for that. Definitely some key numbers being put out by especially the car makers like Maruti Suzuki and Hyundai. So let me start with Maruti first. 3 key numbers that they've given which you should have your focus on. 80,000 inquiries that they've received in this particular period. That's starting from GST rate cut, and they've also mentioned about 75,000 inquiries have just come in the last 4 days. That's from 18 September. That's number one. The other thing is they've already delivered also 30,000 cars in this particular time frame as well, and that's largely been delivery on the first day of Navratri. This is roughly about 1/6 of the company's monthly sale that the company has done on the first day of Navratri itself, and that's a key positive momentum. And 50% of all bookings and inquiries have come in from the small car space, so that's been another key one. So it's a huge bump up, Navratri especially for the likes of Maruti Suzuki. When you look at that, similar trajectory has been given by Hyundai. They've given roughly about 11,000 bookings is what the company has gotten essentially on the first day of Navratri. This is the highest in 5 years as a key number. The last one was just a post-pandemic when we got that number as well. So it's key. For Tata Motors, that's 10,000 on the first day and 25,000 plus inquiries that they've got on day one of Navratri. What's also interesting is a key beneficiary, someone like CarTrade as well, because it is a classified platform where you see a lot of advertisements being done. They operate platforms like Car Wale and Bike Wale, and a lot of customers before purchasing their car, they do their research on these websites. They've seen a 74% jump in traffic on the day one of Navratri itself. So this will have a ripple effect across, segments, and auto is definitely a big beneficiary of the GST rate cuts. And you're starting to see that these 9 days will be crucial, and it's off to a great start.
Puneet, so much for that. Interesting names coming up there with the kind of bonanza and the blockbuster gains that they're seeing as well. So all your dealers that are in focus. But moving on, let's look at the recent IPOs, and we're talking about lock-in dates that actually open up. We're talking about $21 billion worth of shares that will be opening up. A total of 67 companies will see their pre-listing shareholder lock-ins lifted. Varsha joins us with more details. Varsha, over to you.
Yes, as you rightly said, we'll see a lot of selling pressure when it comes to these companies. At 67 companies will have their pre-IPO lock-in period expire. Let's start with 1 month unlocking, wherein the first companies to see the lock-in expire will be smaller firms like Vikran Engineering and Mangal Electrical Industries, and these unlocking will happen in somewhere in late September to early October. Talking about 3-month locking in November, there are a lot of companies wherein the the lock-in period will end. This includes JSW Cement, you have HDB Financial Services and Kalpataru, and these are significant due to large volumes of shares involved. Even for a 6-month locking, the largest unlocks are set up for November and December. You have Ather Energy, have a massive 44% of total outstanding shares will become available. For Aris Infra Solution, you have almost 54% of, even Prostrum Infosystem will see lock-in period ending. So overall, if you see, the market could see a significant increase in sell side pressure due to these companies who has a lock-in expire in coming few months.
Thank you so much for that, Varsha. In fact, Kush, at this hour, with the way markets are panning out, anything that comes to your radar which could be a good opportunity?
So I'll stick to the banking names that we discussed. Bank of India is one stock that is still holding ground, still gaining ground. So is Bank of Baroda. I think Sequent Scientific, the weekly pick that we discussed yesterday, had a good run, seeing some profit taking and consolidation. So for eventual targets of 220 with a stop loss around the 195 mark, we could continue. So yes, some pockets are are still interesting. And largely what we're seeing today could well be, an expiry move, today being the weekly expiry. So yes, I think Nifty consolidating around this level is also fairly good.
Okay, so banking names become the top priority for Kush as well. But thank you, Kush, so much for joining us on the show. We'll quickly step into a short break. Lots more lined up on the other side. We'll get you the top buy today, sell tomorrow picks as well. Please stay tuned.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. quiet day for the markets, very, very flat, except for the Nifty IT, which after starting off flat is now down in trade yet again. So that is the one sulk, if you have. Banks are thwarting that, but IT currently sulking. Amit Goel, CMT, SEBI registered advisor and partner at Blue Oak Wealth, with us also on the show, along with Mr. G. Chokalingam. And Amit, I wonder if the derivative positions suggest any kind of breakout move either on the index, benchmark index, or for that matter on Nifty IT. What do the positions suggest?
Yeah, hi, good afternoon, Neeraj. Thank you for having me here, and good afternoon to all the viewers at NDTV Profit. It's such a refreshing thing to be in the afternoon session rather than the early morning where I have to give, a quick morning calls and everything. This is a much more relaxed session. So thanks for having me at this point in time. However, coming to the indices, I see absolutely no momentum in the indices. Every rally, if you remember the last time we discussed, Nifty at 25,500, Bank Nifty at 55,500 levels were my resistance points, and we have taken drubbing from there. There has been some amount of profit booking on both the indices from those levels. While we do see Bank Nifty, trying to give some sort of support from lower levels. However, I am not all that convinced about this move. If you look at the derivatives data, it's purely a range-bound derivatives data. There's nothing much to read in it. For Nifty, it is 25,500. For Bank Nifty, it is a wider range between 55 and 56,000. Until and unless the 25,500 on Bank Nifty and on Nifty and 56,000 on Bank Nifty is taken out convincingly, I do not really see any trend. Any traders who are looking to capitalize on this can do with non-directional setups on the major indices.
Amit, hi, good afternoon. What about your picks for the day? In terms of the Bank Nifty, you said the charts, the derivative space is not indicating a very positive momentum, but what are the counters that you are looking at in terms of trading right now?
Yeah, as a trader, one would want to have some longs and some shorts in their books all the time. Paying heed to that, I do have a couple of momentum picks for, let's say, a BTST or for a couple of days. Incidentally and ironically, they both happen to be banks, and AU Bank and IndusInd Bank, to be precise. AU Bank has been discussed quite in depth by Kush and the team, and I concur with that vision that AU Bank on the charts has given a sort of a move above the moving average of the 20-period moving average on the daily time frame with very strong volumes today. So the price action, it has broken out of a range, and I am bullish on this stock for the time being, wherein we could look to enter at the current market levels, keeping a stop loss just below today's low, which is around 700, and we will work for targets of 760 to 800 levels. Purely trading call here. I could also discuss IndusInd Bank if needed.
Please.
Yeah, sure. So IndusInd Bank also has a similar trajectory. In fact, after about 3-4 months, IndusInd Bank has, for the first time, moved above the 20-period moving average, indicating that there is some sort of reversal, some sort of value buying creeping into this stock. Some fundamental news also has been positive. So it might have some tailwinds to it as far as I see. Given the volumes supportive and given the price action today, similar setup as AU Bank. Counter specific, I'm looking at going long here at the current market price, keeping a stop loss of 730, which is around the day's low, for targets of 780 to 800 again.
Okay, interesting. After a long time hearing a buy on IndusInd Bank, keep in mind, Mr. Chokalingam, now they have a CFO as well, not a very well-known entity, but out there, a CEO in place, etc. Is there a fundamental case to try and buy into what could be a story of resurrection, IndusInd Bank?
Fundamentally, it's very attractive, trading close to one-time book value. My only concern is that whenever such a governance issue happens in the financial service industry, they take a much longer time period to get back the valuation multiple which they used to enjoy in the past. The prime example is Yes Bank. Despite global institution taking a substantial stake, it is not able to improve its valuation multiple. Even half of the level it has enjoyed before it had a governance issue. So that is the only concern. But otherwise, yes, I completely agree that IndusInd Bank looks very attractive in terms of price to adjusted book value.
So that's IndusInd Bank at the day's highest levels. But moving on, HCC, that should be another one we should look at. They've bagged a 2,600 odd crore order. And apart from that, what is interesting is the Ventura note on the company. They're recommending a buy for a target price of 64. It's almost 120% upside from where they started off with. Stock is seeing around gains of 2.7%. In fact, Amit, let me come to you. What are charts indicating with the HCC? Would you warrant a target price of 64 on the counter? Yes, that's a fundamental target price. But do charts also see that kind of positivity?
I don't see 64 dur tak on the charts, so to speak. Right, but as a technical analyst, the momentum seems to be with HCC. Notwithstanding today's move as well, with strong volumes. So keeping a stop loss of about, around 28, 27 levels, one could probably continue if they have invested in this for possible targets of about 32, 34. 64 is too far off from my perspective.
34 is what you're looking at in terms of HCC, but a few other small cap stocks that are buzzing in trade today, from a Reflex Industries to a Om Infra and a Crizac. Jasmeet is standing by to tell us more. Jasmeet, over to you.
Well, right, thank you for that. The small caps are buzzing in trade today, starting off with the Reflex Industries, where the stock is nearly up 18% in trade. Well, this comes in after the company announces a demerger. The company's green mobility segment is getting demerged and forming a separate entity by the name of Reflex Mobility Limited and getting listed on NSE and BSE, while the green mobility segment caused a drag in the profit. So the delisting is positive for the market, and that's why the stock is buzzing. The next one in my list is Om Infra. Well, the stock is up nearly 6.5% in trade today, while what we see is the buzz is behind of a volume where it's 3x over 30-day average. If you look at the order book of the management, currently standing at 2,600 odd crores, and management is penciling in those orders to get converted. Further, management has guided a margin of 8 to 10%, while the current margins are at 3 odd percentage. While the next one on my list is Crizac. We spoke to the management recently, and the stock is roughly down 10 odd %. While what we see is that company deals as a education platform where they connect students with the universities. And if you look at the revenue, it's nearly up 60% on YOY basis for FY25 at 850 odd crores. While the management also says that they don't see any headwinds from the US market, given any headwinds in US market gives tailwinds in the UK business, and UK business roughly contributes 95% of the overall revenue. While the last one is Tina Rubbers, the stock is up nearly 7% in trade today. It's behind the volumes. The volumes are roughly 9x over the 30-day average. If you look at the capex that company has planned, it's roughly 100 crore over 2 years, and management has also formed a further rubber plant in Saudi Arabia. So these are the small cap buzzers in trade.
Well noted. Jasmeet, thanks a lot for that. 7% up for Tina Rubber. Amit Goel, a Tina Rubber or a Crizac or a GMDC, anything that stands out for you?
I really do not trade these small cap and mid cap stocks simply because they are too volatile for me as well as for my clients. So do not really have a view on them.
Okay, Mr. Chokalingam, a Tina Rubber or a GMDC?
Among the stocks your colleague discussed, I looked at only two. One is Reflex. It looks good, based on the performance and valuation. And I would give a sell call on Om Infra.
Okay. Fair. Sell on Om Infra, 7% lower. Why so, Mr. Chokalingam?
If you look at last 2 years performance and PE multiple, it doesn't give you any comfort.
Okay, Om Infra. I'm just trying to see if that stock looks, Mr. Chokalingam is talking about the PE, the trailing 12 months PE is 56 times. And I think what Mr. Chokalingam is saying that the performance has not been strong enough to support a trailing PE of 56 times. Frankly, there are a lot of other businesses which might be available for much lower. Some volume buzzers in trade. One of them is, of course, KC International. You heard the management today on NDTV Profit, 31 times volumes relative to maybe the 5-day average. Tata Investments, about 15 times averages. Borosil, 13 times. RR Kabel, about 9 times. And, well, we spoke about Tina Rubber, 8.34 times. So, second day in a trot now for Tina Rubber, both price and volume buzzers. But more importantly, RR Kabel, after a while, really zooming up in trade, as is KC International. This RR Kabel, Havels, etc., Mr. Chokalingam, or a Polycab, Do you like these businesses? They've come back from the negativity that was there on those stocks when the Adani Group decided to invest into this business. They've come off from those lows. Are they good enough to invest in?
Yes, KAC International looks good. I have done a study on it. Considering the industry prospects, KAC International looks good. And in YSN cable segment, I would go for Finolex cable. That is only laggard. But I am pretty confident that Finolex cable can do well, sitting on huge cash and a lot of expansion happening. Stock price also down almost 40% from 52-week high, and got a strong brand image among the customers. So these are the two stocks I would recommend.
Okay. The other pack of stocks that is in focus today is the rice stocks, and this is because there is a September data that has come out which indicates that rice reserves in government houses are up 14% on YOY basis in September itself, and this is expected to support higher exports. But the new paddy harvest is also set to arrive, and probably because of this, government agencies could face storage challenges from here on, and plus considering the surplus that would come in versus the demand that is there for these rice exports could probably put pressure on pricing as well going forward. And traders are actually tracking right now the exports, the kind of stock bulking that is happening, and that could probably put a downward pressure on the pricing, and export realization for a lot of these companies could be under pressure. This includes likes of LT Foods or KRBL. Mr. Shoklingam, I'll stick with you again for this one. Rice stocks, anything like a KRBL or LT Foods that you like?
KRBL I don't track after seeing a lot of regulatory allegations. I am not saying that it made anything wrong, but based on the news flow, I would avoid. LT Food looks good for long term. One may consider for long term.
Okay, so LT Foods a long-term bet, but all the three counters trading under pressure almost near the day's lowest levels, and probably these could be pressure that could be coming in terms of prices when it goes to the export market, taking into consideration the kind of surplus that India is sitting on, which will then go into the export markets, and that is what could put pressure. But moving on, in fact, a special segment which is profit intelligence. Before we get across to our profit intelligence segment, let me take in a quick question with Amit as well. Amit, one stock that has been doing its ups and downs right now is a Vodafone Idea. After the Supreme Court came out and said that they will hear their AGR plea as well, the stock did see some smart gains. That up move probably has continued, a 4% up move, but still it's at around 8.7. Would you still look at it as a trading bet? Because we've seen highs of around 13 on this counter. 23-24% is the up move that has already come in the last 1 month.
Yeah. So Vodafone has been a crowd favorite, so to speak, simply because it trades sub 10 rupee level. So there is this psychology that you can buy a lot of shares and have a bigger share. That's precisely one of the reasons why it always tops the volume charts. However, I am not a very big fan of this stock because if you've noticed for the last 1.5 years, it has been in this range and it has not really given a breakout. Every time it has tried to give a breakout, it has faltered to deceive. So until and unless it crosses 10 rupees on a sustained basis, and if it does give a retracement, I would then look to buy into it from a confirmation basis. I would not really join the bandwagon right now. It's a difficult stock to trade, so to speak, because it does have its moments of very strong volatility.
Citi, in fact, had come out with a report where they are giving it a high-risk buy, and they have a target price of 10 as well on Vodafone. So the technical and the fundamental view matching for a 10, and a breakout post that probably Amit could see some buying interest. But moving on to a special segment, Profit Intelligence. Today we're looking at a comparison between two cement companies wherein you have Ultratech Cement, which is one of the top losers on Nifty 50, versus a Shree Cement, which has got a good target price from a Citi. Yet again, Puneet joins us with all the details. Puneet, over to you.
Well, thank you for that. So the latest trigger is definitely, the note by Citi on Shree Cement. They've maintained a target price of 35,500. 3 key points they've made in the report before I move on to a comparison with Ultratech Cement. management largely remains optimistic on the second half recovery. They roughly, the estimate is that 17 million ton of cement has already been sold. They are looking to, do a similar number in H2 of FY26. Possible increase in private capex as well as a cut in GST rates from 28 to 18% should be a demand booster, is what the brokerage affirms. And finally, a very interesting point, this is the first one which has actually come across and said it, that the region of East India, where Shree Cement is a stronghold, post Bihar election or just tad before that as well, could see a higher and a faster growth compared to the northern as well as the southern region of India. And the analyst has stuck out the neck and said it, because the eastern region hasn't actually performed in terms of growth, especially in this particular time frame. When you look at the management guidance, and here is the key one, they're expecting 37 to 38 million ton of cement to be sold in FY26. They've reaffirmed their guidance of 80 million ton capacity by FY28. It's a steep ask, doubling capacity essentially. The capacity currently is between 50 to 55 million ton, with overall sales and utilization hovering at 75%, but it's a steep ask to go all the way up to 80 million tons as well. Capex will be roughly 4,000 crores over the next 3 years. That's an annual number. So they will be continuously investing in increasing the capacity to the number which we mentioned. Now, what do brokerages actually anticipate in terms of growth compared to Ultratech Cement in the next year, FY26 specifically? Revenue growth for Shree Cement is expected at 12%, while Ultratech will have the higher boost at 17%. But EBITDA growth will also be the same for someone like an Ultratech at 26%, at 28%, pardon me. The EPS growth will be 28% for Shree versus 30% for someone like an Ultratech Cement as well. Finally, in terms of valuation as well, where do they stack up? In terms of buy calls, Ultratech does have 82% analysts covering the stock, giving a buy recommendation. The return potential is also significant at 10.7% versus about 4.9% for Shree Cement. And in terms of EV and EBITDA, largely neck and neck in terms of valuation. So the key aspect for Shree is the stock hasn't performed that well in the last 3 to 4 years. So the growth aspirations is strong. The company is also refrained from any kind of much acquisitions compared to Ultratech, which has done Kesoram as well as India Cement. So they are looking to boost capacity to 200 million tons. But that's for our profit intelligence segment. Putting the focus on Shree Cement, that will be the one to watch out for. H2 will be the biggest area for growth essentially for Shree Cement, leading up to FY28 when the capacity is expected to reach 80 million tons.
Okay, Puneet, thank you so much for bringing us those details. Mr. Oklingam, your view with regards to where Shree Cement stands, because as Puneet mentioned, second half is a promising quarter for them, and going forward, the kind of capacity expansions that they're taking, going forward, things are looking nice. Do you agree with that?
I looked at 3 more parameters. That is, FY25 was a little difficult time for cement players. So in that year, how these 2 companies managed their operating profit. When I see that, Ultratech managed to keep operating profit intact in FY25 over 24, whereas Shree Cement has not done that well. And second, if you look at the PE multiple also, Ultratech is far cheaper than Shree Cement. Third, even the return ratios are far better for Ultratech. So between these 2, I would prefer Ultratech. I would not give too much importance to expansion of cement capacity in the near future, because the whole industry is seeing a lot of cement capacity expansion, and capacity utilization is somewhere around 75% range. So one has to see, how the industry is able to keep raising the realization when the capacity is expanded. So therefore, that will not be a major, criterion for evaluation. Rather, I would give importance to the 3 parameters which I mentioned. So therefore, I prefer Ultratech to Shree Cement.
Okay. By the way, stocks which are perking up, despite the fact that there is also this high on gold, rupees come off as well, but there are individual pockets really perking up in trade. So TCI and TCI Express as stocks have done very well. Keep an eye out for them. There is GMDC. And viewers, I think what's happening is that the rare earth related plays are really shooting up. Anything got to do with base metals, rare earth. Hindustan Copper has had a phenomenal run too in the recent past. GMDC is having that run today, and look at those volumes there. 52 million shares traded for GMDC on a single exchange alone. That's the extent of the uptick that we get there. Amit Goel, how is the price volume action in GMDC? And parallel to that, if you can give us your BTST strategy for the day.
So GMDC, in fact, all the metals, the metal index has been on fire today, and noticeably so. GMDC at with a gains of about 11%. I don't know if I would want to join the bandwagon at this moment. Maybe if there is any dip in this, because the momentum is very strong. Any dip towards 580, 560 levels, I could probably look at re-entering this stock for trying to catch it at a retracement. My BTST calls, on the other hand, are slightly interesting in the sense that I am recommending to book profits from an auto stock and shift that money into another auto stock, which is book profits in Maruti and shift that money into Ashok Leyland. The reason is very simple, that when we had met in the mid of August, I did give a buy call on Maruti around 14,000, 14,500 levels for targets of 16,000. So that target has been achieved. And if you notice the auto index, in which Maruti happens to be the heavyweight, we do see a markings of a shooting star pattern, which is a profit booking or a pause in the current trend. Hence, any smart investor who has taken, who is sitting on some profits on Maruti could look at booking that profit there. And I also noticed that Ashok Leyland, on the other hand, contrary to what the index is showing a lot of strength and momentum in it. So keeping today's low as a stop loss, I would recommend traders to take some position here for ultimate targets of around 150 or 155 levels.
Okay, that's an interesting switch between a Ashok Leyland and a Maruti Suzuki as well. So I think that is something you should be watching out for. But let's quickly look at something that NDTV is looking to unveil soon. Lots that is lined up so far, and I think this is something which is going to be, Neeraj, the buzz, the beat, and the glitter,
the groove, the glow, and lots more. So it's certainly turning out to be a very interesting launch and something that you should watch out for. Something's brewing. Keep an eye out for what that is. The unveiling happens tonight at 8 p.m. I can see some word out there, but can't quite figure out what it is. Let's see.
The time is important.
The time is important. Okay, let's see how it shapes up. But keep an eye out on the network for this, for sure. Okay, we've been talking about what to buy a number of times. The question is, things that have come off, is there a need to sell some of those as well, even though they might be down? Now, Mr. Chokalingam, it's a contrarian view that I'm asking you, but there are people who are saying that because of the uncertainty surrounding the IT business, even if the earnings don't get impacted, will we see a mild derating in the multiples further from where they are right now? And therefore, is it advisable to switch out of IT into some other pockets which are exhibiting strength? What would your thought be?
Certainly, yes. I completely agree with you that this is a time to consider selling all large IT stocks. A lot of headwinds. I mean, we all know what has happened to H1B visa. Of course, it is clarified only one time, but it is estimated that it can impact even up to 5% of the margin. The problem is, in case there is a further delay in successful resolution to the bilateral trade agreement between US and India, then there is a threat of service tax also being imposed on these companies. In any case, the large IT companies have not been growing more than 2 to 4% their dollar revenue exports. So a lot of headwinds are there, and the timing is very, very improper for this particular sector. What used to be a defensive sector lost its defensive tag. It has even started dipping, its profit from these stocks as compared to run up in Sensex and Nifty. So I think even now it is not too late to sell large cap IT stocks.
Okay, all right. So that's with regards to where IT stocks are concerned. But the primary markets this week, is buzzing left, right, and center. The main board space itself is going to raise around 7,200 crores. Today also we are seeing opening of 4 IPOs, and we spoke to some of these managements. We spoke to management of Anand Rathi, Sesha Sai Technologies, as well as Jaro Institute about their company's growth model and outlook going forward. Listen in.
This is the second company which is coming in public from our group. Basically, earlier, about 3.5 years back, we came with a wealth company which is listed in a market site. So this is a purely broking and distribution company. This is one of the oldest company. We started our capital market journey 30 years back, way back in 1994, and since then we kept on adding various different businesses, various different verticals. In this company, what we are doing, we are catering to almost all category of customer, from retail to MNI, HNI, NRI, corporate, and institutional. So all kind of a category of customers, we are satisfying the need of investments of any individual investors who are dealing with this company. And primary idea is how investments need of a specific customer should be satisfied.
Just to give a flavor of the customer depth that we have, 10 of the 12 large public sector banks is what we service, 15 of the large 21 private banks is what we service, 9 of the 12 small finance banks are our customers. We have a very deep penetration into the general insurance and the life insurance space. So yeah, we've been a long-standing player in the BFSI space for some time now.
We are among the top few initial players. Since 2009 we started our journey, and we did wonderfully well. We have multiple tabs with IITs, IIMs like I'm Ahmedabad, I'm Trichy, I'm Nagpur, I'm Kozhikode, I'm Mumbai, I'm Indore, IITs were IIT Delhi, IIT Madras, IIT Bombay, IIT Kanpur, and so on. On the university side, we have multiple universities like Symbiosis International University, D.Y. Patil, Manipal University, Amity University, Chandigarh University, Amrita University, so Parul University for that matter. So good partnerships, good learning, and good learning means a good word of mouth around. So we don't spend on TV ad or some ads like that, but we do good work, and education is a evergreen field.
Mr. Chokalingam, producers are telling me we're out of time, but one IPO out of the lot that you would advise an investor to subscribe to, and I will add a JK Energy to the list as well. 45 times is the subscription. A quick answer to that.
All risk-taking investors should apply for IPO and book profit on the listing day.
Okay, so all of the IPOs is what you're looking at. Thank you so much for that. I think, Mahima, that's interesting. In fact, thank you, Amit. Thank you, Mr. Chokalingam, as well for joining us on the show. All IPOs should be subscribed for listing gains.
For listing gains. Interesting takeaway coming in. But let's take a look as to how the markets are closing. Well, in the past 2 days, there's not been a much traction in the markets. They've not moved much. The Nifty 50 now closing around 0.1% lower, below the 25,200 mark. The Bank Nifty, however, has led the show today, up almost 0.4% as we speak, well above the 55,500 mark. Let's try to pull up the Nifty 50 heat map and see as to how and what stocks have buzzed in trade today. That includes likes of all these banking names, BFSI names, IndusInd Bank, Axis Bank, Bajaj Finserv, something like Maruti has also done pretty well in trade today. JSW Steel, Adani Enterprises also has come back into the green territory and bounced back to that 1.5% mark. But something that's been under pressure, Trent continues to be under pressure, down 2%. HUL, Ultratech, Nestle, HDFC Life, Asian Paints. So some consumption names seeing profit booking. Let's try to pull up the sectoral heat map and see as to how sectors have fared throughout the day. PSU Bank now closing 1% higher. Nifty Metal also closing 1% higher. Private banks seeing gains of about 0.6%, followed by Nifty Auto seeing gains of about 0.5%. In terms of what's seeing profit booking, Nifty FMCG down 0.2%, Nifty Realty down 0.9%, Nifty Defence also down by about 0.8%. Let's try to pull up the advanced decline ratio because that will give us a picture as to how the broader markets are looking like, and the chart has in fact widened by the day, and it's in the past hour especially, because now we have around 950 odd advances versus that of 1400 odd declines. So that ratio is almost more than 1.5:1 in the favor of bears, of course. Let's try to pull up the broader markets and see as to how mid-cap 150 and small-cap 250 is doing. The mid-cap 150 down by about 0.3%, the small-cap 250 down by about 0.5%, and closing at almost today's low point. Let's try to pull up the BSE 500 and see what are the counters that have done well and what are the counters that have not done well. Tata Investment up 10%, TCI up 6%, KIOCL, NLC, Voda Idea, some counters in the green. On the flip side, there's profit booking seen in Adani Total Gas, Zydus Wellness, Vedant Fashions, KRBL and Sammaan Capital, some counters that are down by about 4%. But with regards to what you should keep your eye out on today, post-market hours, what are the cues that you'll be watching out for? Well, Eye on the Globe includes your US Fed Chair Powell's speech. You will have to see as to what he has to say with regards to how the next leg of rate cuts will come in from. In terms of corporate actions, SMS Life Sciences will be trading ex-dividend. In terms of the demerger coming in, Shankara Building Products shareholders will receive shares in new entity and the ratio is 1:1. In terms of the board meeting, Piccadilly Agro Industries is going to hold a board meeting. So the commentary coming in or maybe some filing coming in will be something interesting to watch out for. Lastly, in terms of shares that will exit anchor lock-in includes Mangal Electricals, where around 4% anchor lock-in exit is expected. In terms of IPOs, like I said, primary markets is on a buzz this week. EPAC prefab IPO opening size is around 504 odd crores, of which 300 crores is fresh issue, and IPO band is there on your screen. Then we have BMW Ventures, IPO size around 231 crores and price band anywhere between 94 to 99. Both of these IPOs opening tomorrow, so keep your eye out on that. With that, we're completely out of time on this edition of India Market Close, but do stay tuned to NDTV Profit for more news and updates on the other side.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola? Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio.
Welcome, you're watching Market Express and I'm your host Makshi Bahugna. Now let's get straight into the show. So viewers, despite recovering from the day's lows, benchmark indices ended in the red for the third consecutive session. The Nifty wrapped trading above 25,100 levels and the Sensex concluded just past 82,000 levels. Both the indices closed almost flat but with a negative bias. The Nifty index was largely uplifted by shares of frontline banks like Axis Bank, SBI and Kotak Mahindra Bank. In fact, most of the constituents of the Nifty bank ended with the gains, with the index itself settling nearly 0.5% higher. Broader markets have underperformed the benchmarks, with both the small and mid-cap indices ending with higher cuts. The Nifty Small Cap 150 saw higher selling pressure as opposed to the mid-cap index. The sectoral picture also ended mixed, recording more losers than gainers. Nifty, FMCG, Realty and Defence were the top sectoral laggards. On the other hand, the PSU Bank, Metal and Auto indices lead the charge. Gold prices have scaled a fresh record peak and is on track to record its best year since 1979, with a gain of over 40% so far in 2025. So the precious metal has been driven by a combination of macroeconomic forces, including expectations of an extended Federal Reserve easing cycle and also a weakening US dollar. So analysts remain constructive on the outlook for gold, with some predicting that the price could actually climb towards $4,000 per ounce by mid-2026. Now on to a counter that was buzzing away in trade. KEC International has bagged new orders worth a whopping 3,243 crore rupees. So the new contracts are primarily for their transmission and distribution business, securing projects both domestically and also internationally. Now, among the significant wins are projects for 400 kV transmission lines in the United Arab Emirates. So the company has also landed new supply orders in the Americas, which include providing towers, hardware and also poles. Next up, we have Hindustan Construction Company. So it has secured contracts worth 2,566 crore rupees for phase 1 of the Patna Metro Rail project. Now, these contracts involve the construction of 10.67 kilometers of underground tunnels using tunnel boring machines and 6 new metro stations. So this is a significant addition to its order backlog, which already stood at 11,188 crore rupees as of June 2025. Goldman Sachs has upgraded its rating on Maruti Suzuki to buy from neutral, setting a new target price of 18,900 rupees, which is a significant increase from its previous target of 13,800 rupees. Now, this bullish outlook is driven by several key factors. The firm also anticipates a potential surge in demand for entry-level cars following recent GST cuts. So Maruti is re-entering the new model market after a 2.5-year hiatus with the launch of the Victoris SUV and the Evitara, a new electric vehicle. So this is actually bound to be a very key trigger for the growth. So the company is also well positioned to benefit from the upcoming auto demand cycle and also a low carbon dioxide risk profile compared to its competitors. Let's keep it going with the brokerage notes as well. So Nomura has reiterated its buy rating on Hyundai Motor, raising its target price of 2,846 rupees. So the brokerage firm's positive outlook is based on the company's strong growth prospects in India. Nomura also forecasts a 9% CAGR, which is a compound annual growth rate for India's auto volumes from 2025 to 2030, which is a period during which Hyundai may actually need to increase its production capacity to meet the rising demands. Next up, we have Jefferies. So Jefferies has initiated its buy rating on Patanjali Foods and also raised the target price to 695 rupees. So the brokerage anticipates a gradual recovery from the company's edible oil and food businesses throughout the fiscal year 2026 as market headwinds normalize. Next up, we have Motilal Oswal. So they are keeping its buy call on AU Small Finance Bank with a target price of 875 rupees. So the brokerage firm believes that earnings are set to pick up for the company in the second half, Loan growth also remains strong with a projected 24% CAGR till FY28. Deposits continue to flow and cost of funds may ease, helping NIM recover from Q3. So cost ratios are expected to stay in control. On to a note from CLSA now. So they have talked about Indian regulated power utilities. They've seen subdued returns year to date due to lower than expected demand from climate change related factors. So the brokerage sees an opportunity to buy select stocks. So the report highlights that India is the world's third largest power market and also forecast a demand uptick in the second half of the current fiscal year. The brokerage firm also stated that nuclear power will be the next focus for the sector. Anand Rathi kicks off coverage on IMFA with a bullish buy rating and also a target of 1510 rupees. So growth is expected to be fueled by capacity expansion and rising steel demand. The company's value accretive diversification could add 300 crore rupees in annual revenue with over 8% of ferrochrome demand driven by industry and also India's appetite growing. So IMFA is well positioned for a strong run. Next up, we have Alchem Labs. So they have stepped up its cancer care game with a fresh launch that is Pertuzza, which is a biosimilar pertuzumab. Now, this injection is designed to treat HER2 positive breast cancer, which is a common aggressive form. So with the Pertuzza now available in India, Alchem aims to make advanced treatment more accessible and also affordable. We have Dr. Reddy's labs in focus now. So they've moved closer to the European market entry with a key regulatory nod. The European Medicines Agency gives a positive opinion on AVT03, which is a biosimilar of Prolia and also Xgeva. Now, Prolia treats osteoporosis while Xgeva helps manage bone complications from advanced cancer. Next up, we have Shilpa Medicare. So they've gotten an initial approval from the European Medicines Agency. Now it covers the generic Rivarox Aban tablets. Now this drug fights blood clots, deep vein thrombosis and also stroke risk. So the European market for such medicines hit $2.5 billion. Now the green light came from Shilpa's Dabaspet plant near Bengaluru. Now, it's the third prescription drug from this unit to win European approval. Now, this boosts Shilpa's export push in the generics. No big changes to forecast yet. Investors see it as a win for steady revenue from Europe. Premier Energies shines brighter on investor radar as Vendus initiates an ad rating with a target of 1100 rupees. So the company is a leading integrated solar module manufacturer and they're now ramping up its manufacturing capacity. So brokerage firm believes that with a demand-supply mismatch in solar cells and rising preference for Indian-made modules, Premier is well positioned to ride the clean energy wave. Jubilant Pharmova's board approved Arun Kumar Sharma as the Chief Financial Officer and also key managerial personnel. The decision came at today's meeting on September 23. It also followed a recommendation from the Nomination, Remuneration and Compensation Committee and also the Audit Committee. So Sharma, with over 30 years of experience in finance, steps in from October 1. India's auto sector has witnessed a historic surge in sales on the first day of Navratri, driven by the implementation of GST 2.0 reforms. So Maruti Suzuki, Hyundai and Tata Motors have reported record-breaking deliveries with over 50,000 units sold in a single day. Maruti Suzuki alone delivered over 25,000 vehicles with 80,000 customer inquiries recorded on the first day of Navratri. The company's senior executive officer, Partho Banerjee, described the response as phenomenal and also noted that demand for small cars has been especially strong. Hyundai Motor India reported around 11,000 dealer billings on the first day of Navratri, which is marking its best single-day performance in 5 years. So Tata Motors have delivered approximately 10,000 vehicles with over 25,000 inquiries received on the same day. So the used car market also saw a significant surge, with Cars24 reporting a 400% jump in the car deliveries on the first day of Navratri. The Ministry of Consumer Affairs has also received around 100 complaints from consumers across the country, alleging that several companies and shopkeepers are not passing the full benefits of the GST. So the government has urged the public to actively report instances where GST benefits are not being passed on by the retailers or the online platforms. So in response to the growing number of grievances, the ministry has formed a special team to actually monitor and also track these complaints submitted through the portal. The Reserve Bank of India is now considering a proposal that would allow lenders to remotely lock mobile phones of customers who default on their loans. So this move aims to reduce the bad loans and also strengthen the recovery mechanisms, particularly for small ticket loans below 1 lakh rupees, which have historically shown higher delinquency rates. So non-bank financiers have sought RBI approval for a device locking feature that would actually disable the core device functions but retain the access to emergency services, ensuring personal data remains secure and inaccessible to the lenders. To activate this feature, lenders would actually need an explicit consent from the borrowers as well. So the RBI had previously asked the lenders to disable this feature due to concerns over third-party loan providers misusing it to invade the customer privacy. However, regulatory structures nearly killed the market for mobile phones financing in the smaller towns. Next up, we have SpiceJet. So it has secured its second credit rating upgrade in a month, with Equity raising its long-term rating to BB. So Equity highlighted SpiceJet's diversified revenue streams and growing fleet capacity as key factors supporting its revenue profile in the near to medium term. The agency also noted that the recent settlement with Kalyal Aviation Partners with improved SpiceJet liquidity position by providing cash credits for future aircraft and engine maintenance. Union Minister Ashwini Vaishnav announces his switch to Chennai-based Zoho's office suite for documents, spreadsheets and also presentation. Now, this move promotes homegrown tech amid PM Modi's call for Indian products over foreign ones. So it ties into the government's self-reliance drive, especially with the GST Bachat Utsav starting September 22. Now, Zoho has already managed Meiti's email services since September 2023 and has also won a web browser challenge in March. So, Vaishnav has urged others to follow the suit. The step boosts the local IT firms and also cuts the reliance on global software. Future plans include Zoho's role at Startup Mahakumbh 2025. The Employees Provident Fund organization has released its provisional payroll data for July 2025. The data reveals a significant addition of over 21 lakh net members. Now, this marks a 5.55% growth in the net payroll additions compared to July 2024. Now, this indicates increased employment opportunities and also heightened awareness of the employee benefits. The 18 to 25 age group dominated the new subscriptions with 61.06% of the total new subscribers added in July 2025 belonging to this age bracket. So approximately 9.79 lakh new subscribers have enrolled with the EPFO during the month, with 5.98 lakh first-time job seekers have also signed up. According to the latest Purchasing Managers Index data, India's private sector growth has slowed down in September. So the HSBC India Manufacturing PMI has dropped to 58.5 in September, which is down from 59.3 in August. Similarly, the HSBC India Services PMI has declined to 61.6 compared to 62.9 in August. The HSBC India Composite PMI, which combines both the manufacturing and services sector, also witnessed a decline, falling to 61.9 in September from 63.2 in August. So despite the slowdown, the Indian private sector continues to expand, with business activity and also new orders showing robust growth. Anand Rathi Shares and Stockbrokers launches its IPO today. The book-built issue runs until September 25. Now it aims to raise 745 crore rupees through a fresh issue of 1.79 crore crore shares at 393 rupees each. Now, funds will fuel the long-term working capital needs. The firm also boasts diversified revenues from full-service broking and also growing margin trading finance. Now, it serves over 221,000 active clients. Risk include market slowdowns and also tight SEBI rules. Now, GMP stands at 30 to 70 rupees, which is hinting at a listing, listing gains. So, listing eyed for September 30 on BSE and NSE. Europratik Sales, a decorative laminates and also wall panels company, made its stock market debut today. It listed at a premium of 10.7% on the BSE and 10.2% on the NSE. The shares opened at 273.45 rupees on the BSE and 272.1 on the NSE compared to the issue price of 247 rupees. Now, the company's initial public offering was subscribed 1.41 times overall. So, Europratik Sales raised 451.3 crore rupees through its IPO, which consisted entirely of an offer for sale by the promoters. Now, the company will not receive any sort of proceeds from the IPO, as the objective was to provide an exit to the promoters and also list the company's equity shares on the stock exchange. NVIDIA is now set to progressively invest up to $100 billion in OpenAI as the company's partner to deploy at least 10 gigawatts of NVIDIA systems for the OpenAI's next generation AI infrastructure. The company will finalize the partnership and the details in the coming weeks. First gigawatt of NVIDIA systems to be deployed in 2H, that is the second half of 2026. Now, this comes on the back of NVIDIA investing $5 billion in Intel. NVIDIA shares have jumped nearly 4%, which is high on the back of the announcement. Amazon sued the New York State Public Employment Relations Board to block it from enforcing a new law that the online retailer considers an attempt to illegally regulate and also the private sector labor relations. Now, in a complaint filed in Brooklyn Federal Court, Amazon accused New York of engineering an unconstitutional power grab by letting the regulator known as PUBSERP, the National Labor Relations Board's primary authority, to address the union organizing, collective bargaining and also workplace disputes. India's rice reserves in government warehouses jumped over 14% year-on-year in September. Now, this massive stockpile is set to fuel higher exports. Traders across Asia watch closely as ample supplies keep the demand in check and also prices subdued. Bulging inventories exert downward pressure on the global rice prices. India's record levels signal weak pricing ahead. Exporters eye opportunities amid the steady output. The surplus also eases food security fears but squeezes the margins. Overall, it points to a buyer's market for rice. Now, in a tit-for-tat escalation, India has extended its airspace ban on Pakistan Airlines and also the aircraft, including military flights, by another month until October 24. The fresh NOTAM issued on Monday mirrors Pakistan's recent extension. It also marks the sixth consecutive month of the reciprocal closures that began after the deadly Pahalgam terror attack in Kashmir on April 22nd, killing 26 people. So while foreign carriers can still overfly both the nations, Indian Airlines face massive detours on 800 weekly flights to Europe and beyond. The Karnataka High Court has granted interim relief to multiplexes and others who challenged the state government's order to cap the movie ticket prices at 200 rupees. The court has stayed the order, putting the price regulation on hold. The petitioners, including the Multiplex Association of India, have argued that the price cap was arbitrary and also would impact their businesses. So they claimed that the Karnataka Cinemas Regulation Act does not empower the government to fix the ticket prices. So senior advocate Mukul Rohtagi, representing the association, pointed out that a similar order was passed in 2017 as well, but was later withdrawn. He argued that multiplexes have invested heavily in creating cinema halls, and also the price cap would actually restrict their ability to conduct the business. At least 7 people have died of electrocution in Kolkata as heavy rains left parts of the city heavily waterlogged, bringing traffic on road, train operations and daily life to a grinding halt amid Durga Puja buzz. Airlines have also issued advisory and flight operations were severely affected, with more than 30 flights suspended. Now, Hong Kong has shut down ahead of the super typhoon Ragasa, the world's most powerful tropical cyclone this year, with authorities urging people to stay at home. As you can see on your screens right now, the visuals are terrific. While most passenger flights were due, to be suspended until Thursday, people have piled into supermarkets, leaving little on the shelves as panic buying set in, and residents stocked up on the necessities for fear that shops could be closed for 2 days. When I pass away, Assam should sing this song. Zubeen Garg had stated about Mayabini when it debuted in the 2001 Assamese film Dag. And with tears in their eyes, his fans sang his beloved songs as they said their final goodbye. His cremation took place in Kamarkuchi on the outskirts of Guwahati. Hundreds of thousands of fans have gathered to pay their last respects to the singer. Assam declared 3 days of mourning. Aryan Khan's latest Netflix series is under fire for a scene where Ranbir Kapoor vapes an e-cigarette without a disclaimer. Critics say that it glamorizes a banned substance, violating India's 2019 E-Cigarette Prohibition Act. The National Human Rights Commission has also issued notices to the government and also Mumbai police demanding an FIR against Ranbir, Red Chillies Entertainment and Netflix. With that, viewers, it's a wrap on this edition of Market Express, but please don't go anywhere and stay tuned to NDTV Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
The world's defining stage. Leaders, visionaries, decision makers, confronting the challenges of our time.
हमारा प्रयास होगा भारत की सेंचुरी, सिर्फ भारत की नहीं बल्कि पूरी मानवता की जीत की सेंचुरी।
NDTV World Summit 2025, Edge of the Unknown, 17th to 18th October, only on NDTV. Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Benchmarks end flat after erasing losses from intraday lows, with Nifty closing below the 25,200 mark. Sectoral indices closed mixed, with the Nifty PSU as the top gainer. Rupee settles at a new closing low against the US dollar, ends 44 paise below Monday's closing at 88.76 after falling to a fresh low of 88.8 a dollar. 4 IPOs open for subscription today, with Seshasai Tech being the largest size at 813 crore rupees, followed by Anand Rathi's share and stock broking with an issue size of 745 crore rupees. And it's a bumper start to the festive season for auto companies, as small car bookings at Maruti see a 50% surge, while Hyundai records the highest single-day dealer billings in 5 years. Both the companies see high walk-ins. Consumer Affairs Ministry receives over 100 complaints on the first day of GST 2.0 rollout, most about GST benefits not being passed on. Sources say the ministry has deployed a team to monitor and verify complaints. As complaints mount that GST 2.0 is not delivering benefits to consumers, officials are awaiting detailed field reports on 54 product categories, and sources say are avoiding any knee-jerk responses so as to allow the new rates to settle. Heavy rains paralyzed Kolkata ahead of Durga Puja, leaving pandals submerged. 7 people have died so far in rain-related incidents, and 100 flights have been affected. The NDTV network is gearing up for an interesting new launch. More details ahead on the show. Good evening, you're watching Profit 360 on NDTV Profit. I'm Sanjana. First up, let's take a look at our top focus this evening and how the markets fared today. We saw Nifty 50 and Sensex ending on a mixed note after erasing most losses from intraday lows. Nifty was in the red for the third consecutive day, dragged by Tech Mahindra and Trent. On the sectoral front, it was a mixed bag as well. PSU Bank emerging as the top gainer, while FMCG emerged as the worst performing index. Puneet now joining in with the wrap of all of the market action from today. Puneet, over to you.
Well, it was a day that saw pressure across the board, but the Nifty 50 did end at 25,185, just a tad below 25,200 mark. It is, though, above the 10-day EMA levels of 25,150 levels, and that will be something that the bulls will be happy about going into tomorrow's session. Today, we saw the Nifty losing for the third consecutive day. That was led by stocks such as Tech Mahindra as well as Trent, with the IT pack largely seeing some pressure again today and a lack of revival, to say the least. Amongst the mid-cap and the small-cap index, that was also subdued in the trading session today. The mid-cap ended the red, and that was led and dragged by some key stocks like Bayer Crop Sciences as well as Emphasis. Again, a trajectory where you can see the lack of revival in the IT names, despite being under pressure yesterday, largely based on the hike in fee for the H-1B visas by the US government. Apart from that, the small caps as well continue to be in the red. Stocks like Sammaan Capital as well as Vedant Fashion were the top losers in that particular index. But within the sectoral heat map, if you can say the least, you saw the continuation of trends from the last week as well as yesterday as well. The PSU emerged as the top sectoral gainer. It is up almost 6% in the last month versus almost a flat returns for the Nifty Bank, continuing to show strength in the index. That was led by stocks like Canara Bank as well as SBI. We also had a positive note by CLSA on SBI, where its market cap could be $100 billion in just the next 1 year. They had a similar note for Bajaj Finance as well on that same metric. So continue to see buying in PSU banking index. We've also seen the FMCG be the top sectoral losers. That was led by GCPL, with that's Godrej Consumers, as well as Radico Khaitan, while the metal continued to gain for the fourth consecutive session in a row, and we're seeing strong strength with built-in stocks in that particular index as well. The banks, the autos index snapped its 2-day losing streak today. Autos were in focus, based on brokerage firms like Goldman Sachs that actually upgraded stocks like Maruti, but seeing some sell-off today as well. Going into tomorrow's session, we will be looking at a 25,150 level as a key support, and that would be a starting point for the market.
Thanks for that, Puneet. And we also spoke to N. Jayakumar, the MD and Group CEO of Prime Securities, and he gave us his insights on how to navigate market uncertainty and find top investment opportunities. Let's listen in.
Actually, the good news is that a lot of the bad news is already in the price. A, our markets haven't been performing vis-a-vis their global peers. B, we've had the worst, I feel, of tariffs and tariff-related rhetoric, tariff-related bombast, which has been sort of played out. We've had sort of sobering noises in terms of people wanting to now talk about a deal that could happen. So we've gone through the full circle. We've had earnings disappointments, and now we have a situation where corporate balance sheets are as deleveraged as they've ever been. The private sector capex, in a sense, the greenfield capex is also beginning to start off as one of the things that was not there over the last several years. It was largely the public sector that was carrying the way forward. Keeping all this in mind, inflation is under control. Liquidity is very good. RBI is going all out to provide ample and more liquidity to the banking system. And in that context, I mean, really, I would say that it's a confluence of multiple factors, and especially the global tariff play out that's happened over the last several months. And I think paradoxically, providentially, whichever way you look at it, we could end up with one of the best deals.
Meanwhile, 4 companies have opened their initial public offerings for subscription. From financial services to technology and education, a diverse group of firms are looking to raise capital. Let's get more details from my colleague Anushi, who joins us with a comprehensive look at each of these offerings. Anushi, over to you.
Okay, so I'll start off with Anand Rathi first. Now, it is a well-established broking industry that we are looking at. So that's the first one on radar. Now, price band about 393 to 414. And this is the IPO size of 745 crore. A complete fresh issue is what we are seeing. They'll be using this funds for working capital requirements. Now, key strengths of this is firstly, they have diversified revenue streams. Along with that, the MTF business is aiding growth. However, on the weakness side, any impact in terms of market volatility will impact the operations of the business. Second one in focus is Seshahi Tech now. Now, this is with the IPO size of around 813 crore that we are looking at, which comprises of a fresh issue of 480 crore. Key strengths here is that it has a leadership positions in the payment solution industry. However, BFSI industry contributes around 81% of its total revenue. In fact, top 10 customers also accounting for about 66% of their total revenue is what we are seeing. The third one in radar is Jaro Institute of Technology. Now, this has come out with an IPO size of 450 crore, which comprises of an offer for sale of 280 crore, and the rest is fresh issue of around 170 crore. They'll be utilizing these funds towards marketing and clearing debt. Key strength it has a market-leading positioning in this online higher education segment that we are looking at, but it derives 81.4% of its revenue through its top 10 customers. So concentration risk is what we are seeing. The last one on radar is Solar World Energy. Now, this is within IPO size of 490 crore with a fresh issue of 450 crore is what we are seeing. They'll be utilizing the funds towards investment in their subsidiary for higher benefits over there. Key strength is that it has a robust order book, with order book standing at 2,500 crore. And it operates on an asset-light model. But on to the weaknesses, the top 5 to 10 customers, if we look at, they contribute to 97 to 99% of their total revenue. So there is a concentration risk that we are seeing for this particular company. So these are the 4 IPOs which are in focus today, opening for subscription.
Thanks, Anushi, but stay with us because we also saw the Adani Group stock surge in trade after SEBI's clean chit on the Hindenburg allegations. We saw the market cap of the companies has also increased significantly since February 2023. So give us all the details on that.
Well, it's a big power through that we are looking for Adani Group set of companies. In fact, if we look at what has happened since SEBI's clean sheet on Hindenburg allegations, the stocks have seen a strong rally, and this is something that we've seen across the board taking place. In fact, if we just take February 23 in consideration, where the stocks were at their lowest, from there on we have seen significant uptick in terms of where the market cap addition is. In fact, 8.7 lakh crore is the kind of size that we are looking at, just in terms of how the market cap has increased in these last 2 years period itself. And this was led majorly by Adani Enterprises, Adani Power and Adani Ports. In fact, this is reflected with strong investor confidence also coming through, because if we look at the returns also from the February 23 lows, the stocks have seen significant upside from those levels as well. If we just take the first one in consideration, Adani Power up over 6 times from February 23 levels, while Adani Ports, Adani Green Energy, Adani Enterprises have seen their stocks more than doubling to what those levels had been. Ambuja Cements also clocked in about 80% of an uptick in terms of that. In terms of how the market cap addition has been since SEBI's clean sheet on September of 18, we are looking at almost an addition of over 1.78 lakh crore. Now, this is a significant addition in terms of market cap just in these last few trading sessions itself. Again, if you look at the upside to this, this was majorly led by Adani Power, Adani Green Energy and Adani Enterprises, which have remained in focus. So this is the overall picture that we've seen taking place after what has happened after this Hindenburg saga, how SEBI has now given a clean sheet and how the market cap has increased significantly, showcasing strong investor confidence remaining for this group set of companies.
Thanks so much for that, Anushri. And let's move on to what's happening on the GST 2.0 front. India rolled out the GST 2.0 with the promise of cheaper goods and fair prices. But the ground reality is telling a different story. Sources say nearly 100 complaints were filed on the very first day, most from consumers alleging that businesses are failing to pass on the benefits. The government insists relief will reach shoppers, but for now, the savings remain out of sight. My colleague Danish now joining us with all of the details.
NDTV Profit has exclusively learned from sources in the Ministry of Consumer Affairs that on the first day of new GST rates, there were around 100 complaints that were received across the country, and these complaints were being filed on a specific portal. And now the government has clearly said that they will ensure that the proper GST benefits are rolled on and passed on to the consumers. And a special team has been formed by the Ministry of Consumer Affairs, which is tracking a particular portal. And on this portal, those complaints are also being forwarded to the companies. So all in all, if we see, the government has ensured that the GST benefit is fully passed on to the consumers. And just in case if there's any company which is not passing it on, or maybe normal local shopkeepers that are not passing it on, they are telling the public to go on that website, log in and register a complaint. And moreover, whichever company or whichever shopkeeper is found guilty of not passing on the full GST benefits to its consumers, then the government is very likely to take a class action step against these companies.
Right, thanks Danish, because as complaints pile up over GST 2.0 not benefiting consumers, the government says it is closely monitoring whether businesses are actually passing on the gains. Sources say that officials are waiting for detailed field inputs on 54 product categories that are expected by September 28th. But for more on this, let me go across to my colleague Rishabh, who has all of the details. Rishabh, what are you hearing from your sources?
We've had a lot of complaints over the past 24 hours on certain products in certain Kirana stores, especially not passing on the GST benefits. This is something that was brought to Consumer Affairs Minister Prahlad Joshi's notice as well. He said the government is looking into it. Now today, what we have picked up is the fact that you have government sources that are actively tracking the status of whether these GST benefits are actually making their way to the end consumers. What we're also looking at is the fact that the field formations that CBIC had put in place, especially with regards to the 54 product categories that it has specified that include anywhere from toothpastes to ice creams. All of those inputs will start coming in starting September 28th, and that is when the government is waiting for in terms of more solid on-ground inputs coming in on whether these benefits are actually being passed on to consumers or not. what we're also picking up is the fact that the government is very cognizant of the fact that you cannot have a knee-jerk reaction to such a reform. It takes time to sort of settle in, and these are very heavy reforms that have been brought in by the government, so they are very cognizant of that fact as well. And the government has also made it clear that these GST reforms might not be an immediate uniform story of happiness being passed on to the consumers. There will be some roadblocks, there will be some struggles, but eventually all of these benefits will make their way to the end consumer. So that is what we're picking up in terms of these GST 2.0 benefits actually translating into lower prices for on-ground customers.
Thanks for that, Rishabh. And at the Asokham GST conclave, CBIC member Shashank Priya stated that there remains a strong appetite for GST reforms with the ongoing efforts underway. He also announced that provisional GST refunds for low-risk categories will be implemented starting October.
When we made a study of 90%, we have already a provision for zero-rated supplies that 90% of the refund claim will be given upfront within 7 days of a complete application form, but it was not happening. For various reasons, officers were being very cautious. So, and as I mentioned now, GSTN being what it is, with the kind of data we have, we are able to harness it to say, okay, we will shift to the next step. We will now make use of the system to categorize which is low risk, which is high risk, and low risk without any intervention, without any interference of officers, it will be credited to their account. So that's the next step that we are doing, and this we are going to bring about from 1st of October, from after starting of the next month. And the new thing we are doing is on inverted duty structure again. We have proposed that 90% refund, like for exports, will be given upfront, and there it is not in the rules, so it will take time. In the next budget only we can change the law to incorporate it. But the central government has taken a decision that we need to facilitate trade, and therefore we are proposing to issue an instruction and make this applicable from next month itself. So we are working on that instruction, and hopefully it should be out soon.
Now, NDTV Profit's checks have revealed a shift in retail sales in Mumbai, with manufacturers passing recent GST cuts to retailers through quantity schemes over the past 8 to 10 days. For instance, an item that was previously priced at 123 rupees, including GST and retailer margin, is now offered to retailers at 110, reflecting the lower GST while maintaining margins. However, no mechanisms exist to ensure small retailers pass these savings to consumers. Many continue selling at old printed MRPs at updated packaging with revised MRPs, or increased grammage is only expected by mid-October. Our Mumbai check shows some consumer awareness of rate cuts, but most are still paying the earlier prices. But with the rollout of GST 2.0, auto companies are witnessing a significant surge in bookings, with small car bookings up nearly 50%. This boost directly benefits Maruti and Hyundai, and my colleague Danish is joining us with all of the details.
Well, it was a blockbuster first day of Navratri for a few auto companies. Tata Motors has recently announced that on the first day of Navratri, they delivered 10,000 cars and they received 25,000 inquiries. As far as Maruti is concerned, Maruti delivered somewhere around 30,000 cars on the first day of Navratri. And since 18th of September, that's when Maruti had announced that they will be passing on the GST cuts to its consumers. So from that day itself until 22nd September, the company has received around 80,000 inquiries for new cars. And as far as Hyundai is concerned, Hyundai has done dealer billing of 11,000 dealer billings yesterday, which clearly means that Hyundai is also seeing a huge demand for its cars, and hence a lot of dealer billing has happened. But overall, if we see since a very long time, from the past few months, we were seeing a slowdown in PVs, especially in small cars. But as per Maruti, there has been a 50% jump in inquiries for small cars. So all in all, if we see, the first day of Navratri has been really blockbuster. And for the remaining 8 days, the auto industry is very positive and very confident of continuing with such great numbers.
Thanks, Danish, for that. And clearly, this festive atmosphere has arrived at car showrooms across the country, with the recent GST cut bringing what some are calling an early Diwali. The impact is immediate, like we have been reporting. Car sales have reportedly doubled since yesterday. But for more on the scene, let me go live to NDTV's Sam Daniel, who brought us this report from a showroom in Chennai.
It's a surge in demand for new cars since yesterday, the day the new GST structure came into force. In fact, entry-level cars have become a lot cheaper now. From the earlier 28%, it's now 18%. Even SUVs and luxury cars have become cheaper by 5%. From the earlier 45%, now it's 40%. We come to you from the Kia Capital showroom in Chennai's Adyar. And joining us now, Mr. Mohsin Ahmad, to give us a sense of the kind of surge in demand for new cars they witness in the city. Thank you very much.
Thank you, sir.
Give us a sense of the rise in demand now.
So the sales has gone up by almost like 2x, we could say that. So the people were actually waiting for this. This is a huge, basically the difference that has come up actually for the first time buyers who were like actually looking out for the car to make out a purchase actually.
And moving on, we spoke with Zoho CEO Mani Vembu, who believes that India's digital ecosystem is at a crucial turning point. While speaking to me earlier today, he emphasized that building software domestically will fast-track innovation and added that this is crucial as uncertainty around US H-1B visas encourages talent to stay in India. He also posed a key question. Are engineers ready to commit to Indian startups and compete on the global stage? Let's listen in. We're hearing from the Prime Minister's direct call for every Indian household and shop to embrace Swadeshi products. And right after that, we saw Minister Ashwini Vaishnav making headlines by ditching global apps for Zoho's suite. What does this shift mean for homegrown tech brands like yours? Symbolic gesture or a turning point in India's digital ecosystem, you would say?
So it's definitely going to be a turning point in India's digital ecosystem. And we are seeing this happening, like, right, say, in different parts of the world where, like, right, say, the data sovereignty is becoming a critical, important equation in terms of choosing a tech vendor. So, and with that, given that, so we have been building all the software from India, so the platforms, everything, right? So everything is being built in India, and we look at it as a turning point for India. So overall, right, say our tech landscape and the innovations that is going to come up. So we are looking at this as a turning point for sure.
Just as India is taking pride in Swadeshi tech, we're also seeing these comments especially coming at a time, actually a day after that the US sharply raised H-1B visa fees, putting fresh obstacles before skilled Indian talent abroad. Is this a nudge for young engineers to build careers and products at home, or do global opportunities remain vital for India's tech progress? What do you say?
In my view, personally, I feel it's a good sign because a lot of talent is going to stay in India. So that means we are going to build more stuff from India. And with the population we have, I think we need indigenous solution because some of the solutions have to be also unique. So we can't just use some solution that is built somewhere else for our own problems. So our own infrastructure problems and our own, a lot of different problems are very unique to us because of the population and the density of the population. So that means we are going to see a lot of innovation that is coming out of India, like how UPI has happened. So, right, say that kind of innovation, I think, will accelerate now with this move.
And before we slip into a break, something is brewing at NDTV as the network is getting ready for a blockbuster reveal. It's about to start a new chapter in the lifestyle segment. Stay tuned as the curtain lifts tonight at 8 p.m. this evening.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
The world's defining stage. Leaders, visionaries, decision makers, confronting the challenges of our time.
हमारा प्रयास होगा भारत की सेंचुरी सिर्फ भारत की नहीं बल्कि पूरी मानवता की जीत की सेंचुरी बने।
NDTV World Summit 2025, Edge of the Unknown, 17th to 18th October, only on NDTV. Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa, 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 whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of
Hello and welcome to NDTV Profit. A very good morning to all the viewers. You're watching Know Your Company, that is KYC. I'm Hiral Dadia, and with me is Mahima Vachojani. Good morning, Mahima. Interesting company that we're talking about today, which will actually see benefits of GST also trickling in. Yes, we're talking about Shoppers Stop. Let's first understand why are we talking to Shoppers Stop today. First up, to understand the GST benefits and the kind of demand surge that probably could be coming in as well for the company, and what's that demand outlook looking like. On number two, on the back of GST benefits, is there a margin improvement trajectory that we should be watching out for from here on? So these are the two main questions that we're looking at, and others I think Mahima will also take us through.
Right, so the aspect that I would be looking at would be competitive intensity, you know, because the competition in this particular space is rising, especially big players coming in with big expansion plans also on cards. And as to what competitive edge strategy that Shoppers Stop is adopting to, you know, distinguish them from the big players that are already there or coming in the markets. The other part is the debt reduction plans. What are they looking like, both in terms of long-term and short-term borrowing? And lastly, in terms of store expansion, what are the plans going in? How is that going to, you know, pan out in terms of being capex heavy or asset light? And what is the kind of course, capex amount that they'll be watching out also for?
Absolutely. So these are the key questions that we are looking at, but let's quickly understand about what Shoppers Stop does. I know all of us are aware because people and all of us are used to shopping at a Shoppers Stop. But firstly, established in 1991, it's a retailer of fashion and beauty products as well. And clearly, it's got international and national luxury prestige with premium brands that are being sold at their stores. If you see in terms of the segments that they cater to, from shoes to watches, bags, beauty, home decor, a one-stop solution that you're looking at in terms of where the various segments go.
Right. So even in terms of product portfolio, you know, they've got a basket, a variety of portfolio under their umbrella that includes your fashion apparel, accessories, beauty and skincare, and home essentials. With regards to where the overall network stands for Shoppers Stop, around 299 stores across India is what they're holding right now. 800 plus brands they're catering to in their shops. 70 plus cities is where their presence also stands right now. And right now, the overall area that they cater to is around 4.5 million square feet in terms of where, you know, all of their stores stand, be it Intune, be it their departmental stores or whatever. All of these 299 stores is, you know, filled into this area of 4.5 million
And I think what's interesting over here is in the previous quarter itself, I don't think so they did any store addition. And from here on, I think what that expansion plan looks like is going to be key. From 299, what's that aim that they look at? So that's going to be an interesting point to watch out for. But let's quickly understand their strategic pillars now. Now, First Citizen, this is very interesting because the First Citizen members itself contribute nearly 80 to 85% of the sales, and this is actually underscoring the continued loyalty-led strength in terms of where Shoppers Stop goes. Then you're talking about beauty, the private brands that they hold, and the infant wear. But First Citizen, absolutely key over here that we should be watching out for. So that's with regards to what the company is all about is what we're talking of. But let's quickly look at the rating parameters from here on. We will be looking at the income statement check, balance sheet, return ratios, cash flows. Then we will also look at the shareholding pattern of the company, the street credentials, the street coverage, and the valuation picture. To be noted that the valuation is going to look slightly skewed, taking into consideration some bit of inconsistencies that we've seen. So the price to earnings is what we are considering over here, but we will come back to that as well. But let's first start with the income statement. Now, overall, if you see, you know, it's a very interesting story because it shows a strong recovery, and this is starting from FY22. If you see the numbers from 24-25, the 3-year compounded growth is around 22% in terms of the gross revenues. Margins have remained at that 15 to 17% bracket, though it's seen a dip in the last year. And if you talk about the net profit as well, that saw a sharp decline in FY25. But the transition from loss to profit is the key for a Shoppers Stop, because in FY21 on the back of COVID, it saw a sharp decline, a strong rebound that did come in FY22-23, and the sustainability is what we are seeing between FY24 to 25. So that's the overall picture that you're talking about. And if you talk about just the previous quarter, that's the first quarter, it's delivered a strong top line performance, but it was mainly aided by sustained premiumization trends is what we saw, and the customer engagement was very much stronger. Now, there were no new departmental stores that the company actually added during this quarter. If you talk about their average ticket value as well, which is the transaction cost, that grew by nearly 6% on a year-on-year basis. And if you talk about the selling price, that saw an increase of around 3%. And that is actually reflecting a healthy shift when you talk about customer behavior and the category mix that you can talk about. In fact, the company's value fashion vertical, Intune, that also delivered some bit of a robust momentum, with sales actually doubling on a year-on-year basis. And 4 new stores were added on that front, which is actually probably reaffirming its, relevance in a value-conscious consumer environment.
Absolutely.
So that's what you're talking about from an income statement, and that's why a thumbs up right now.
And that's what, is going to benefit them in terms of where the GST stands, because below that 2,500 mark for apparel, the GST rate has come down and set to benefit a counter like Shoppers Stop. But with regards to where balance sheet is concerned, in terms of where, of course, the overall equity and other equity stands, it's been stable. The other equity profit plus reserves growth has been growing, mostly because it's a cash business. But with regards to where borrowing stand, there have been, an increasing trend in terms of where both the long-term plus short-term borrowing stands. This does not include the lease payments, but from a 126 crore in FY23 to a 340 crore is what the increase in borrowing has been like. But in comparison to that, something like a cash in bank has, come down in terms of where the trajectory stands, from a 31 crore in FY23 to almost 14 crore in FY25. So the question really here is whether they'll be able to reduce their debt position in the near future. Are they actually planning to reduce their debt position? And this all depends on how they're also planning to expand their store. If they're planning to borrow more money, then the company will see an increase in debt also. And because right now the cash is not enough to pay off the debts that's there on the balance sheet, we've taken a conservative approach here and given it a thumbs down.
Right, now let's actually link this to the cash flow. Now, if you see the most recent years, that's FY23, 24 and 25, the cash flow from operating activities, that has remained consistently positive, and that actually has become the primary source of cash for the company as well. While there might be slight fluctuations, the overall trend is one of stability and growth, which is a positive sign for investors. It also shows that the company's increased revenue is actually translating into actual cash flow and not just accounting profits. In fact, it has transitioned from a cash-burning entity during the pandemic to a business that is consistently generating positive cash flow from its operations. In fact, this positive cash flow from operating activities is being strategically deployed to fund capex for future growth, which was actually negative, earlier, and to pay down the debt and strengthen the balance sheet. Now, the debt becomes a concern over here, as Mahima was also pointing out, but this is a positive factor right now that we are considering, so hence a thumbs up.
Right. Okay. So the next one is the return ratios that we're looking at now. If we take a look at the ROC numbers, the trajectory has been declining. There was a point of time in FY23 where it reached to that 15% mark, but since then the return on capital employed has been coming down from a 15% to that 12% and 8% in FY25. So from here on, whether the return on capital employed will increase is the question right now, and hence we're again being conservative here and giving it a neutral rating right now.
Right. Let's look at the shareholding pattern. Slightly neutral, because one aspect is that the promoter stake has remained stable. In fact, over the last 3 years, it's consistently in that range of 65.5 to around 65.6 kind of range. Institutional investors is a pretty mixed signal that you're picking up, because the mutual fund holding has actually shown a general upward trend. Although there have been some recent fluctuations, the recent quarters have seen a slight decline in the mutual fund holding, but this is mainly probably a result of profit booking after the stock's significant run-up, or a shift in investment strategy, or even the profitability decline that we've seen that could have impacted. FIs, though, have shown a very volatile trend, and that is what you can see over here as well. From a 7.43%, it's actually come down to 3.09 now. So there is a notable decline in their stake, and hence, again, a very neutral rating on this one.
All right, the next one is Street Cred. Now here, in the past 1 year, the stock's not done much. In fact, has given a negative return of 35% to its shareholder. Year to date also a negative 8% return. But for the past 5 years, the stock has seen a growth of around 252%. So because the 5-year performance has been decent, considering the 1-year performance, we've seen the underperformance of the markets itself, we've given it a neutral rating for now.
Okay, let's look at the valuations over here. It's going to be interesting to see the valuations, because it looks really exorbitant if you see the trailing 12-month right now. It is the most expensive as compared to peers as well, but this is mainly on the back of that volatility, that inconsistency that we are seeing in terms of where the earnings go. I mean, the EPS is the key over here, and that's what is reflected in the price to earnings ratio as well. So hence a thumbs down here on this one.
All right, the last one is the guidance and analyst recommendations. There are right now 4 buy calls, 2 sell calls and 2 hold calls. So it's even Stevens when it comes to your buy, sell and hold, an average upside of around 6.2%. In terms of where management commentary is concerned, they've said that premiumization, loyalty and customer experience will be the central to the growth strategy. Premiumization to improve share to almost 70% by FY26. Intune and Beauty remains their key growth engines, and focus on larger, more premium departmental stores is something that they're aiming at from here on. And lastly, ongoing cost optimization, working capital reduction and omni-channel integration will support profitability from here on. So this is the management commentary coming in quite positive in nature, but since the analyst recommendations as per Bloomberg do not suggest a significant upside potential in terms of where the return stands, we've given it a neutral rating.
So that's a neutral one on that one. Let's quickly look at the overall ratings, where it stands now, because that is going to be key. 2, that's income statement and cash flow, is a thumbs up. You have a balance sheet, which is a thumbs down. You have the return ratios, which is again a neutral. Shareholding, street credentials, street coverage, again a neutral. And your valuations are a thumbs down on the back of the way it is, expensive, and on the back of which a 4 on 8 is the KYC rating that NDTV Profit has given a sharper stop. But on the back of this, let's get in our guest. Kavindra Mishra, Managing Director and CEO at Sharper Stop, joins in. Kavindra, good morning and welcome to the show, and always a pleasure to speak to you at NDTV Profit. Let's start off with GST, the benefits that you're seeing from here on, and the kind of demand surge that is expected, because you have the festive season that has already come in. Your auto dealers are already talking about huge numbers. Is that the situation at a Sharper Stop outlet as well?
So I think the GST Bachat Utsav, which started from yesterday, obviously it's only 1 day. But to give you a sense, the markets have been quite good. So we had a very good July and August. We have seen a much better tracking in terms of the like-for-like for our stores over the last 2 months, and we feel that with the coming up of the GST Utsav, and it's only 1 day, but we saw some very good signs yesterday in terms of the footfalls in the store. So we believe that we should all have a bumper Q3 and a festive and H2 going forward. And the demand has been quite good, by the way, in fashion and apparel lifestyle space. It has not gone down. It has been very positive for us for the last 2 months.
Right. Mr. Mishra, hi, Mahima also joining in. Just want to understand with regards to the kind of demand uptick that you're expecting because of this GST 2.0 and Bachat Utsav and festivities also kicking in. Can you give us a rough idea as to how much of a growth are you expecting from the last year's base?
So, Q1 for us was around 6% like for like. We should be a high single digit in Q2, and it should bump up from there. Exact numbers, it's very difficult to make an estimate, but I think it should be a higher single or a low double digit going forward. That's what my sense is.
Okay. With regards to the kind of margin trajectory that you've seen so far, just want to understand that because of GST 2.0 coming in, of course, this is on apparel that is below that 2,500 mark for you. My first question to that is that how much of your portfolio is covered under that? And secondly, if this is a large chunk of your portfolio, do you think from here on, for you, you'll of course be passing on everything to the customer, but overall in terms of margin trajectory, any improvement that you're expecting from here on?
So if I look at our portfolio, see, out of 100, if 100 is the pie, 40% of our business comes through non-apparel, which is basically not touched with the GST changes. If I talk about the apparel part of it, the 60% part of it, around 15% of that is anyway lower than 1,000. So that also doesn't get touched because that primarily are private brands and some of the categories which we have. For us, we feel that overall, while it will be margin accretive, few of the brands will be increasing their prices because the MRP goes more than 2,500. Few of the brands are obviously reducing it as well as us. For example, for our brands, we are also reducing the MRPs and passing on the benefit to the consumer. I think it will be net very, it will be neutral in that sense, but the demand will pick up.
Okay. Kavinder, this takes me to my next question. You spoke about the way the portfolio is split right now. Do you see a shift happening on the back of higher disposable income in the hands of the people to the premium category? And if that happens, any margin benefits that could start coming in, and not only for a Shoppers Stop, is that the trend that could emerge from this?
So I think it's a great question. So what we are experiencing is that, and we have been talking about this quarter on quarter in our commentary, is that we are seeing premiumization really take an upswing, right? And premiumization is driven by categories. So categories like watches, for example, or fragrances or higher priced apparel are doing really well. So when I say that 6% is our like for Q1, our premium category is actually grew by 9%, and which is helping us in taking the whole pie forward. What happens is when you start selling more premium merchandise, the return on the space is much higher because the throughputs from the stores are much higher. So we typically see that premium to a non-premium, the upsurge in our GMROFs or our gross margins are around 1.3x. And we see that as we move in this journey going forward, we will see this interest, this coming in. We also see that besides apparel, I think there are certain categories like watches or fragrances or in beauty which are seeing a very, very positive surge. And as a strategy, non-apparel is something which differentiates us from a lot of our competition, and that's something which we keep on driving it. And we are seeing the same. And when you speak to our peers across the industry, we see that premiumization is a big trend and will continue to be very, very strong in that.
Mr. Mishra, with regards to the debt that is there on your balance sheet right now, just want to get a sense in terms of any reduction that you're planning this financial year, because you might have certain plans for store expansion as well, and that will also require some kind of funding. What's the overall view here?
So our view is very simple. This year we have decided to ensure that all the new openings are going to happen through internal accruals, and I think we are quite we have planned well for it. And my sense is we will also be paring down our debt. So this would be a year where you will see the debt coming down and all the new openings or renovations. And we are actually renovating quite a few of our marquee stores. We see that happening through internal accruals only.
Kavinder, this takes me to my next question when you talk about renovations of marquee stores as well. A lot of your stores, I would say in Bombay, for example, Bandra, your flagship store, the size has come down, right? What is the strategy on that front? What is the rationale where you're reducing the the area in terms of where Shoppers Stop was existent, and a lot of your brands also are coming down then. So is there a strategy with regards to focusing on particular brands, maybe increasing your sales per square feet? What is that going to look like? And how does it translate into accruals for the business then?
So I would take the example of Inorbit Malad, which is our flagship store. It used to be close to 1.3 lakh square foot in terms of space. We reduced it to around 70,000. We have just opened the renovated store. You would be happy to know that there is no reduction in revenue. In fact, we will be doing better numbers than when we had a larger store. So what we are seeing is you need to redefine your categories. You also need to reduce the number of brands, because as you premiumize, you don't need to carry so many brands. In fact, in our stores, what we are also doing is we are now creating corners for experience. And that's something, again, we talk about a lot in our commentary and actually do on the ground. So there's a kids play area, there is a personal shopper lounge. There are, not in Malad, but we also have coffee shops in our stores, because we believe that that's the kind of experience you need to give to our customers. The idea behind is that you need to right size your stores, and you need to ensure that the stores you need to keep lesser brands, but give brands a larger space to express themselves well. So that is one part of it. Having said that, in our newer stores, so in between we were opening stores around 20-25,000 square feet. In those cases, we have decided that we will increase the size, and going forward, the new stores which we are opening would be closer to a 40,000, which allows us to express the premiumization and the customer experience accordingly.
Okay, so Kavindra, what's the impact it would have on your average transaction value or your average selling price? And anything with regards to a change with your loyalty program? Because if I'm not mistaken, First Citizen has always contributed nearly 85%. So anything that changes on this front, taking your strategy with regards to stores into consideration?
Yeah, I think there are two impacts. One is, when you premiumize, you are able to drive your ATVs higher. So what we are seeing is, over the last quarter and maybe last 12 quarters, we have seen an increase in our average transaction value, which is very powerful, and this is not only driven by increasing the MRP of the product, but we are also able to maintain the items per transaction, which shows a very healthy connection with our customers. That's one. Second, if we talk about our Black Card, or we talk about our loyalty program, I think we are on a very, very strong trajectory there. In fact, when we spoke about Q1 in the last call, we said that Q1 is amongst the best ever quarters for us in terms of the Black Card contribution or the loyalty contribution. I'm happy to share that I think the numbers are only looking up north. But I think the key is that while we are getting a loyalty customers, we are getting a lot of new walk-ins into our stores. So we have been able to increase the funnel by which we are operating. So a lot of times people have spoken to us that, is the departmental store, is that a concept going forward or not? We used to have a lot of challenges in customer entry. We were flattish in Q1, but Q2 sees a very strong mid-single digit like-for-like customer entry increases. So if your funnel increases and you are able to drive more customers to your store, and then through operational excellence and through your loyalty program and your premiumization, you are able to drive the conversion. I think that's something which is working out well for us, and we see that we'll keep on doubling down on that piece. That's a very strong piece of execution we are doing as we speak now.
Mr. Mishra, we've talked about the brick and mortar model that you already have. How's the online sales looking like? Is that the part of your portfolio that's seeing some kind of increase, and what are the trends that you're observing there in terms of premiumization as well?
So, I mean, two things. The customer, so we want to be the most premium omni-channel player in the country in the departmental store format. And what we are seeing is that the way we are able to drive higher throughputs and premium brands on our offline thing is the same way we are seeing on our app as well. It would be, in fact, we were quite surprised because some of the most premium watches actually get sold across the country, where we don't have stores. So I think that's something which is very, very powerful. We invested a lot in rebuilding our Shopper Stop app and SS Beauty. SS Beauty has started picking up very well, and that's doing well. In case of Shopper Stop app also, we did the final rollouts by end of August, and we are seeing some good trajectory there as well. So I think we are very committed to that piece, because we understand that more and more when we speak to our customers, around 70% of the purchase decision or the brand search is happening online, and then customer comes to the stores and buy, and that's something which we are doubling down on as well.
Okay. Kavindra, a 30-second answer. You've already started passing on the GST benefits. How is the response? Good, bad, ugly so far?
Fantastic.
Okay, super. So that's a fantastic, and I think what's interesting is the way you've showcased the kind of savings and price increases on your website as well is very interesting, because it gives a clear picture to a buyer who's an online shopper, and you know, from apparels to footwear, with all the breakup that comes in, where, you know, any discount that you would see on your bill or any increase in price that you would see on the bill as well. But thank you, Kavindra, so much for joining us on the show and sharing an overall outlook with regards to GST benefits and the translation that could be happening from here on. But completely out of time. With that, it's a wrap on this edition of KYC from Mahima, the team that put that show together, and myself. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
The world's defining stage. Leaders, visionaries, decision makers, confronting the challenges of our time.
हमारा प्रयास होगा भारत की सेंचुरी सिर्फ भारत की नहीं बल्कि पूरी मानवता की जीत की सेंचुरी बने।
NDTV World Summit 2025, Edge of the Unknown, 17th to 18th October, only on NDTV. Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit. Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your personal finance questions. Whether that is saving and investing or spending wisely, we've got you covered. And today, I'd like to talk to you about a category of mutual funds that has been gaining a lot of traction. And I think the reason why it has is because of one of its allocations. I'm talking, of course, about the multi-asset category. And in the recent past, there are a few schemes from this category that have done incredibly well because they have an allocation towards gold. Now, even those schemes that had a significant allocation towards gold at the start of this year have reduced their allocation as gold prices have gone up. But the result is that the one-year performance of some of these schemes stand out and compare even quite well with even pure equity schemes. We'll talk about how this category is performed, how you should plan your investments in it, and whether you should run after recent performances and add them to your portfolio. Joining me today is Mohit Gang and Vineet Iyer. Both of you, thank you so much for taking the time today. Mohit, let me come to you first, just to give us a roundup of how these schemes have performed in the recent past. And I think a 1 year and a 3 year time frame would be good to look at.
Yeah. Thank you very much, Alex, for having me on the show. And as you rightly said, I think this category has kind of stood out for its last 1 year performance and has also caught on to the fancy of investors just because of the kind of investments the category is allowed to make. So look quickly, as per SEBI's definition, the category has to invest minimum 10% into three assets: equity, debt, and commodities. And as these funds stand today, most of the funds will have an equity allocation around 65 odd percent, some a little less than that for the tax advantage. Debt would be around 25 odd percent, 25 odd percent, and commodities is one allocation which has swung heavily in all these funds, and you can see major differentiation across the funds in the commodity allocation, which can range anywhere from 5% to as high as around 25-30 odd percent also in some funds. As long as performance stacks up, I think the range is from a 3% performance for last 1 year to as high as around 15-16 odd percent for 1 year. And the category average, I think, or the good performing funds stand around 15% to 11 odd percent range. So that's been the last 1 year performance, which is much higher than what your Nifty has delivered or a mid cap index or a small cap index has delivered in last 1 year. And that's sheer because of the gold weightage and also because of the fixed income weightage in these schemes, Alex.
Yeah, and the reason why we are focusing on that 1 year time frame is that quite a few of these schemes don't have a lot of data. They're not very old. So I want to come to you, Vineet, on what Mohit was saying and talk about the way that different schemes in this category have varied approaches to constructing their portfolios. There are some, as Mohit pointed out, that have a significant commodity allocation, and by commodity I'm specifically talking primarily about gold, and those that don't. How do you describe them? Would they fall into three broad buckets?
So if you actually, first of all, thank you for having me here, Alex. If you actually look at how this category has panned out over the last 3 years, I've got some data points here. So 3 years ago, there were only about 8 funds in this category. And in the last 1 year, this category has zoomed from being 8 funds to about 30 funds now. And one of the reasons why I see there is a increased interest in this category is because one of the pioneers in this category being ICICI Multi-Asset Fund, which they rechristened from a ICICI Dynamic Fund back in 2018. They are now getting about 1,200 to 1,300 crores of SIP every month, which means that there's a good amount of flow coming in. And the industry feels that when there is volatility, they have to come up with a new theme to attract new flows. So I've seen that this has actually encouraged most of the AMCs to come up with this category. And there have been widespread performances of the mutual fund schemes like what Mohit rightly suggested. And depending upon the gold allocation, there has been outperformers as well. For example, if you look at White Oak, which had typically 20% of allocation into gold, which was one of the highest in its category, has kind of outperformed in the last 1 year. In terms of the performances, the returns that it has generated is about 15%. At the same time, if you look at something like a Shriram Finance, which actually took that call wrong in terms of not having a very significant portion into gold, they ended up delivering about a 1.8% negative return. So if I have to put into bucketing system, people who have got the gold call right, they have significantly outperformed the benchmark as well as the peer group. And fund managers who did not get this call right, of course, they have underperformed.
Yeah. Mohit, just to drive home this point, right, because ultimately, by my understanding, you need to have 3 assets at the very least in a multi-asset category. Otherwise, if you don't have commodities, if you don't have a significant allocation, and here I think you can throw in infrastructure, you can throw in real estate, you can throw in a couple of others, but real estate mostly through real estate investment trusts, and we'll come to that question in just a bit. But if you're not doing that and you're primarily allocating in equity and fixed income, then you're not truly different from a balanced advantage fund or certain other funds in the category, right?
Yes, Alex, I assume this question is to me.
Yes, Mohit, it is to you.
Yeah. So look, yeah, you're absolutely right. If it's only equity and fixed income, then it's like any other balanced advantage fund or a balanced fund. If you put in commodities in the mix, and which is what most of the fund houses have very astutely played on in last 1 year, which Vineet also alluded to. I think the entire mix changes, the entire risk reward matrix changes, the complete dynamics changes. Look, a White Oak having almost so they have reduced the allocation, but they went as high as almost 30%, if I'm not wrong, or 25% in commodities. They've now reduced it and trimmed it. But having gold and silver both, and there are fund houses which have also gone more aggressive on silver, has kind of changed the return profile in an year when equities were almost down, flat, or negative in some cases. Also, these schemes by nature can have REITs and InvITs. They have around 5 to 7% allocation. Most of the fund houses will hover around 5% combination of REITs and InvITs, which also has kind of stood out because that gives you a fixed return on the overall portfolio as compared to equities, which have just not given anything for last 1 year. And one important allocation category, which also is a part of some of the multi-asset funds, is the international allocation. If you see, Alex, there are few funds which also does around 10% odd allocation into international stocks, which also has kind of given a positive boost up to those performances. So the category is very varied. Any investor who's getting into this category needs to dissect it completely and figure out what exactly does he want, what kind of asset class does he want to hold, and what kind of risk profile of the fund does he want to get into.
Yeah, it's an important point. So let's take that forward. Before we get into some of these allocations and how the strategy has differed, particularly with commodities. And I do want to drive home that point on silver, because there's one scheme in particular that has gone overweight in the recent past on silver. In fact, we spoke with the head of that organization not too long back, and he did mention that they were doing it. But Vineet, a lot of people have gravitated towards multi-asset to shore up their allocation towards gold. Maybe that's that, or maybe they heard in the media, or they heard from their peer groups that this particular category was doing well, and that is because of gold to a large extent, as Mohit just pointed out. Do you think that the reason why people are getting into the multi-asset category may not be what should ideally be the case?
Sure. So typically, Alex, if you see, investor is like a herd mentality where, if something starts picking up, people would queue up in terms of getting exposure to this. And AMCs are also played out smartly by projecting the category where they are kind of focused most on the gold part. But in reality, if I look at the trend of gold allocation in the multi-asset category, that has not typically gone beyond the 15 to 20% mark. And although, it has been rated like a gold significant allocation. And if I look at the last 12 months trend in terms of the gold allocation, that has been coming down significantly. And today, if we see something like an ICICI is just holding about 3% odd, 6.5% odd with physical commodities and ETFs in gold, and silver also they're barely maintaining about 3%. So I think it's mainly the way the asset class has performed, and that has kind of boosted the multi-asset category in terms of attracting investors, is what I think has played well.
Okay, so let's talk about that gold and silver, right? Because, and I was referring to Quant, which has said that because of, and when we spoke to Mr. Sandeep Tandon, he essentially spoke about the gold-silver ratio. And it must be said that since that point, that gold-silver ratio, which effectively talks about the ratio between the price of gold and the price of silver, which at the peak was at 103 or thereabouts, where the equivalent of the same weightage of silver would you'd be able to buy 100 units of silver from the value of that 1 unit of gold effectively, right? And that has come down quite dramatically because silver prices have gone up, Mohit. But what would you say about that allocation and the way that fund houses have played this commodity allocation?
Look, Alex, I think one word, kudos to the fund manager and the fund house to have identified this opportunity. It requires a lot of gut and gumption to play this kind of a strategy. It's not very easy in Indian mutual fund industry to stand out of the way or out of the crowd and do something of this sort. Having said which, most of the fund houses did take a silver allocation, and they kind of increased the allocation also, but minutely. No one went oversized on silver, and you rightly pointed out the silver gold ratio was around 100, 103. It's now currently standing at around 86. If you check historical levels on silver, that's still very high. The historical levels kind of give a ratio of around 65 gold to silver. At 83, it's still very high, but that also means that gold prices can come down, not necessarily that silver prices go up to match the ratio. Right? But again, these are all tactical calls which perhaps fund managers can take it right on their account. But most of the multi-asset funds otherwise have a silver composition between 2 to 4% or at best 2 to 5%, other than the fund which you mentioned, Alex.
Yeah. Let's take a bit of a sidebar, Vineet, and talk about gold and silver, because ultimately that has been the focus of a lot of investors over the course of the last 1.5 years. And we've enumerated several reasons why gold and silver have done well. I think it's important to note that silver derives quite a large amount, 60% of its value, from industrial usage, and only a 40% or thereabouts from the investment angle. And it's interesting also that a couple of central banks, one in particular, has started keeping a silver reserve as well. But what, according to you, are the reasons why we've seen the rise in gold and silver prices, and do you anticipate that that is likely to continue?
So first of all, I will talk about why silver is actually making so much of news. It's primarily because, like you rightly pointed, about 60% of the use cases is industrial for silver. And if I give you some stats, in 2024 alone, one of the best use of silver is to create the solar PVs. So the growth in solar PVs has actually increased the demand for silver by about 31%. So if I look at the numbers, it was about 257 million ounces that was required. And by 2030, it is estimated that approximately 546 million ounces would be required of silver for solar PV alone. And if you look at the countries which are going to be demanding this, China stands out, where they will be requiring about 20% of the total demand of silver by 2030, followed by India and US. Apart from this, if you see, the production of silver has been going down consistently. So over the past 5 years, the demand has been more than the production. Partly it is supported by the recycling that the industry has been doing, but it's not been meeting the demands at all, because of which also the demand being higher, supply being lesser, the price has kind of enhanced. If I talk about gold, gold historically has outperformed whenever there has been uncertainties both on the economic side as well as the geopolitical side. And we have all seen in the past 3 years, starting from the Russia-Ukraine war, how there has been a lot of geopolitical uncertainties. In the last 1 year or so, we are seeing a lot of economic uncertainties because of the US trade tariffs. And basically, these uncertainties have resulted in terms of people flocking to gold. A lot of central banks are now increasing their reserves, including India, China, Turkey, Poland. These are all stacking up on gold. Although the pace of stacking up has gone down, so we might see some reduction in demand by the central banks. But of course, the retail demand is kind of going up. So these are the two things. And the third thing, why gold might continue to increase, is because of the focus of US on weakening the US dollar, which means that if US dollar is weakening, of course, the demand naturally will go for gold.
Got it. Okay, and that's very well explained. Let's talk about ultimately what an investor should do. Mohit, you referred to their risk profile. And this is important to bear in mind because we've already described different strategies that are employed by fund managers in this category. So when you are going out to invest in these, should you watch for the way that these are constructed? Because it is possible that the tax treatment in a multi-asset fund could be different as well. Some could have an overweight on equity and so therefore will give you an equity taxation, while others will give you that 2-year long-term capital gains tax of 12.5% or thereabouts, right?
Yeah, absolutely, Alex. Look, I think each investor has to determine what his risk profile is and what does he ultimately want to achieve by having this fund in the category. To answer on front of diversification, look, I think if there is a category of investor which doesn't want to actively get involved in allocations between equity, fixed income, commodities, so on and so forth, and he's confused between all these categories, then multi-asset gives him a great choice. It's like a buffet served right in front of you, and you can then, and I think that also you don't have to manage, everything is in your plate, right? So you just have to pick up the plate. And from a taxation point of perspective, if an investor is looking out for equity taxation, then yes, he will have to do his due diligence to figure out which funds out of these are keeping a weighted average equity allocation over 65%. In that case, yes, the taxation is 1 year long-term capital gains taxed at 12.5%, and even then 1.25 lakhs is exempt, the first 1.25 lakhs of long-term gain, and short-term is 20%. But if your equity composition is between 35 to 65%, then the long-term definition changes from 1 year to 2 year. The taxation remains 12.5%, but the short-term gains are taxed at your marginal rate or the slab rate. And if there is a fund which has equity lesser than 35%, then it will be taxed as debt funds. But to my mind, there is no multi-asset fund which is taxed as debt fund right now. But you have multi-asset funds in the second category, which is equity allocation hovering between 35 to 65. So an investor, if he's not looking for a safer profile, but if he's looking for a equity kind of product or a synthetic equity product, which also gives him the benefit of equity taxation, then you have to be extremely careful to select a fund with over 65% of weighted average equity allocation.
Yeah, important point. And by the way, there are schemes in the category, and Edelweiss, for example, comes to mind, where they use arbitrage in order to meet that threshold of equity taxation, right? Or at least they have a larger allocation towards equity, not necessarily pure equity. They have arbitrage, which does not give you necessarily the same equity returns that you can imagine, but it does give you better than fixed income returns. So therefore, Vineet, in your opinion, and coming to the brass tacks, if you have to add some more to this, would you say that the allocation depends on, of course it depends on the investor, but what they have in mind. It is of course a long-term strategy. Nobody's investing in this for a period of 6 months or a year or even 2 years. You're talking about a long-term portfolio. But where does it fit in your opinion? And what are the schemes that you like in the category and why?
Sure. So first of all, depending upon the market levels, I think an investor, if he does not want to take too much of risk, but still have the equity taxation, they can go for portfolios which has a larger allocation to arbitrage, where they are protecting the downside. But of course, if the market starts zooming up, then you don't get the upside. But this is somewhere for someone who is kind of risk averse. But people who are okay with risk taking, then they can go for an equity heavy, with of course the remaining amount going into a diversified commodity oriented allocation between gold, silver, and a couple of other rates and stuff like that. To my mind, a multi-asset fund looks well for a 3 to 5 year horizon. And from that perspective, I think equity-oriented multi-asset fund would do well. Of course, there'll be periods where commodities would outperform, and that will give some balancing result to the portfolio returns. So anything on the aggressive equity side would be my take in the fund, and ICICI fits well in that category.
Okay, ICICI Pru, and it's, as you pointed out, one of the older ones. Mohit, you want to change anything, or you want to have a different perspective on the schemes in the category, what to look for? And by the way, I didn't ask, but a recent notification from the Securities and Exchange Board of India changed the tagging of REITs to equity. Does that change anything from the perspective of the multi-asset fund?
Absolutely. I'll take the second part first, Alex. The categorization of REITs as equity will have a huge impact because now most of the funds which were demarcating REIT plus InvIT allocation to up to 10%, not just in multi-asset but in other funds also, can move the REIT allocation to proper equity allocation. So REIT will now become a part of that 65% allocation under equity category, and the InvIT allocation can also go up. Which was also a combination between REIT and InvIT. Now the InvIT alone combination can go up to around 10% in any portfolio. So my sense is we will see incrementally most of these funds having more and more of REITs, not just multi-asset but other equity funds also. To answer the first part now, which is my preferred choice, yes, I will kind of agree with Vineet now that I will go into equity heavy multi-asset funds standing right now. I think the commodity cycle has got largely played out, so I'm still bullish on gold and silver, but I'll still choose a balance between the two. And my preferred choices out here would be Nippon multi-asset, plus Axis multi-asset and DSP multi-asset. I think I'm going more by a 5-year rolling return performance, and I've seen these funds kind of stand out that their average returns have always been over in the range of around 10 to 12% and even higher for a longish period of time frame. So these are my three choices.
Okay, and the final question, which is amount of allocation. Of course, the suggestion is that you have a broad idea of how much you want your equity to be, your fixed income, and your gold or your commodities, gold and silver. But in this case, you're going to add something. In all probability, most investors have multiple schemes in their portfolios. They have pure equity. Sometimes they also have a pure fixed income, or they have other hybrids. So Vineet, first to you, how would you position this as part of an investor's portfolio? And let's assume here that they're doing this not necessarily because they don't want to allocate themselves, but because they want to have diversification in their portfolio and they want a tactical investment.
Sure. So if I have to talk about the way we approach this category, we typically tend to allocate any money that is required between the 3 to 5 year zone, where we don't want to take too much of risk in the equity. At the same time, we want to also have a position in commodities they play out and kind of be counterintuitive to the equity at large. So that is the category we look at in the multi-asset space between this period.
Okay. And Mohit, so I know that you said that this is, according to you, meant for investors that don't want to allocate themselves, but what if you want a tactical investment in one of the schemes that you mentioned that is more aggressive, maybe in the commodities space? And so from that perspective is providing you with a diversification and removing the requirement that you might have to allocate towards gold and keep investing in it.
Yeah, Alex, so I get that point, and I think it will all vary from investor to investor depending on the kind of profile he or she is. So if you are a retired investor, then perhaps this category serves great purpose because it is conservative in nature. It kind of hedges by itself by virtue of having 3 or 4 asset classes within the overall scheme. So it gives you a natural hedge and a conservative way of running your portfolio. So for any kind of conservative investor, I think anywhere an allocation of 10 to 20% could be a great allocation to have. For someone who's an aggressive investor, young investor, and can manage, then perhaps the allocation to this category could be negligible or lower. But again, as I said, it will all depend from an investor profile perspective and also from time horizon. As Vineet rightly mentioned, if your time horizon is within 5 years, then yes, a pure equity play might not be a great play to go for given the scenario at which we stand currently. Then perhaps a balance advantage or a hybrid or a multi-asset is the right category for you.
Yeah, in fact, both of these gentlemen have suggested that you look at a bucketing strategy. We will talk about that in future episodes. What they mean by that 3 to 5 year time frame is to identify why you would need the money and to plan your investments based on that. Gentlemen, thanks so much for taking the time. Always a pleasure speaking with you. I think this has been an enriching conversation. And that brings us to the end of this edition of Your Money Matters. Thanks so much for listening in, and let us know what you think. Do stay tuned. This is NDTV Profit.
The world's defining stage. Leaders, visionaries, decision makers, confronting the challenges of our time.
हमारा प्रयास होगा भारत की सेंचुरी सिर्फ भारत की नहीं बल्कि पूरी मानवता की जीत की सेंचुरी बने।
NDTV World Summit 2025, Edge of the Unknown, 17th to 18th October, only on NDTV.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं, उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Presenting the all-knowing, all-powerful
Let's get in an interesting conversation going. HSBC Global Investment Research came out with a note on an India multi-asset strategy, wherein they say that while there are 4 factors or 4 variables that explains the performance of Indian equities, FX and bonds, equities look undervalued, government bonds and the rupee are undervalued to neutral, and a couple of catalysts could drive a rebound. One of the authors of that note, Pranjul Bhandari, Chief India Economist, Strategist and ASEAN Economist at HSBC Johnson, right now on the show. Pranjul, great having you. Thanks for taking the time out. And what's the genesis of this, the findings of this report? Because the overarching message from that note as it comes out is that a number of Indian asset classes are undervalued.
Yes, absolutely. Thank you for having me. We try to look at 4 asset classes altogether. This is something which is not really done in India. Either people look at equities or they look at bonds or they look at the rupee, but we try to look at all of it together and see if there are any common drivers. The reason why we were doing it was because we realized that across all the 4 asset classes, India had underperformed over the last year. At a time when emerging market returns were rising, India's returns were falling across these 4 asset classes. So some common problem was there and we wanted to get to the bottom of that. So when we looked at this, we started it, we were amazed to find that only 4 variables can explain much of the movement across all the 4 asset classes. 2 variables are global, 2 are local. In global, we have global growth, which should be supportive of Indian returns. We have the US dollar. Weakness in the US dollar should be supportive of growth of assets in India. And in local drivers, we have domestic liquidity, better the liquidity, more growth in assets, and expectations of potential growth. If people are expecting India's GDP growth to rise over time, then they want to be a part of that story. Between these 4 indicators, we explain much of the movement. Once we had this, what we did was we plotted it all, actual versus modeled. And it was very clear to us that given what's happening to all these 4 variables, equities has now fallen into the undervalued zone. FX is probably undervalued too. Rates is perhaps at the neutral zone. So this was the real takeaway. But the question to ask is, agreed, equities is undervalued, FX is undervalued. There is space and the case that can be made for a rally. But what will trigger the rally? What will be the catalyst? So we went out thinking of a catalyst, and what we found were 2 things. One, and there's no surprises here, if the 50% tariff on India is reduced, that could be a huge catalyst that can drive sentiments for this upward bound. And the second is a series of reforms. We've had the GST reform, but if we line up another couple of reforms, then sentiments towards India's growth could improve and we could see a rebound across all of these 4 asset classes. So this is, what we found. And I think this is heartening. After 1 year of very sluggish growth in returns, there is space for a catch up at this point.
Pranjul, hi. One line from your report that really caught my eye is when you say it's time to sit up, a turning point could be close by. And I found this interesting. It's apparent to everyone that at some point this 50% tariff will be halved. Question is when, and if it's not soon enough, what are the consequences? What is this turning point that you are looking at?
Yeah, look, I'm looking at 2 catalysts. One is not in our hands, broadly speaking, which is the 50% tariff. We don't know exactly when it goes down. It could be prolonged. But the other catalyst is in our hands, which is to basically say that, look, this 50% is not in our hands, but what we can do is we can really strengthen our economy with a series of economic reforms, GST being the first one, but will be followed up by many more. And I think that in itself can provide a huge stimulus to the economy. And I think that is what I'm sort of eyeing at this point more, what we can do in terms of reforms. Now, a lot of questions on what can we do. GST is one. I think it was just a starting point. But there is a deregulation drive going on across central government, states government, and I'm going to watch out for that because these can happen very silently, but over time they can have impact. And a final one is our attitude towards external trade. I think we are becoming a lot more open in attitude than we were in the past, be it trying to now quickly sign trade deals with US, US, EU, Middle East, Australia, or to actually woo other countries to get FDI, thawing of relationship with China, cutting some of the import tariffs we were putting in a lot of imports into India that was increasing cost of production. So I think we have done a lot of external trade reforms over the last couple of months. So my sense is all of this could come together and give us a growth boost over time.
Pranjal, is there some sense of when do these things come to the fore for India? I mean, you guys would have this global team which will be talking to other countries as well about their investment plans into India because of all the measures that you said India has done. Is there a sense of when all of this comes together?
Look, that's a good question. What we are seeing right now is that FDI flows across the world is on pause. Nobody is really investing into each other's countries simply because the rules of the games haven't yet been settled. My sense is, by the time we get to the middle of 2026 and a lot of the tariff rates across countries are known, there are also a lot of things we are waiting for. For example, some exempted sectors like pharma, semiconductors. What happens to that? We get a clarity on that. We got the visa news over the weekend. We hear a little more if anything else is planned out or not, but at least we know a lot of the things get known. I think at that point of time, FDI flows around the world will start again. And my sense is that's the time when India can actually raise its hand and say that we are more open to FDI than we were in the past. We've done all of these deregulation reforms, come and produce in our country. I want to quickly add a nuanced point here. For a long time, India was only attracting high-tech FDI, solar panels, green hydrogen, EVs. But, that is a very partial strategy because many people are wooing that, especially advanced economies who are giving huge subsidies. So all of this money may not come into India. But what we haven't done in the past and we can do now is try to attract more mid-tech FDI, textiles, furniture, footwear, toys, the kind of things which in the last few years ASEAN was making, Vietnam, Thailand, Malaysia, and on the back of that growing their economies quite a lot. We can start attracting a lot of that because a lot of that is also labor intensive. It'll get us our jobs. So my sense is that can be a new leash of life for India. If we become much more open to mid-tech FDI, it'll be good for growth. But my sense is we'll probably see most of this happening around the middle of next year.
Said that, like you said, middle of next year would be the earliest you'd have some impact on that. What have you penciled in as the GST cut impact? When Prime Minister spoke on Sunday, he talked about a figure, 2.5 lakh crore in saving. Now the question is, where does that saving that Indians, the average Indian will have, where does it go? What is the back of the envelope calculation you have in terms of which sectors benefit? We've seen the very obvious and direct impact on smaller cars, passenger vehicles, etc. But where else do you see this being distributed?
Yeah, so the 2.5 lakh crores, 2.5 trillion rupees includes both the income tax cut and the GST cut. So out of this 2.5, 1 lakh crore is coming from the income tax cut, which was announced in February, and 1.5 is coming from the GST. This 1.5 amounts to about 0.4% of GDP. And I would say that is probably the consumer boost that comes out of the GST tax cuts. And my numbers are completely aligning with the numbers that were announced by the Prime Minister. So I'm quite happy that, my numbers are okay. But whether this will impact GDP growth fully or not will also depend what the consumers do. This whole 0.4, if they spend the whole thing, then it's a boost of 0.4 percentage points on GDP growth. So if our GDP growth was 6.5, it could become 6.9%. But sometimes the consumers don't spend it all. They save a part of it, especially if they are nervous about their wages and salaries, in which case the boost to GDP could be lower, say about half, 0.2 percentage points. So I would say that's about the range, 0.2 to 0.4 percentage points on GDP growth from only the GST tax cuts. In terms of which sector, I think the one sector that stands out a lot is, cars. In fact, a lot of the dealers that we talk to, car dealers we talk to, a lot of the channel checks that we do suggest that in terms of questions and demands and orders, they are completely bracing for double-digit growth in the run-up to Diwali. And I think we will see that in most of the other consumer durables as well. I think that will be a big increase. So my sense is, generally speaking, September and October, we'll see good growth numbers. There is a trade-off going on. Tariff is taking away from growth. GST tax cuts is adding to growth. I think over September, October, the GST tax cuts will win. On net, we will do very well. My problem is what happens once Diwali is behind us. What happens in November and December when we don't have a big festival to look forward to, and if 50% is there at that point of time, I think that's when things could start getting a little murky. But right now, over September and October, I think the sentiments will be good.
That's very well put, Pranjal. And if we go by the estimated 8 to 10 week timeline that Chief Economic Advisor talked about, and he of course said this is my estimate, this is not a finality, then we should be fine. But it is on a razor's edge for the next few weeks or so. Thank you so much, Pranjal Bhandari. They're absolute pleasure to speak with you. As always, very lucidly putting together the points. And I think a few big takeaways from what Pranjal Bhandari has said, that equities, all four asset classes that she looked at, equity, rupee, interest rates, bonds, have all underperformed compared to the rest of the world in India over the last 1 year. India is yet to join the party, but there could be a change around the corner, and that is also happening because of the GST cuts. We should start making it attractive for FDI to come in. N. Jayakumar, MD and Group CEO of Prime Securities, with us on the show this morning. Jake's great speaking with you, and always a pleasure to have you with us here on NDTV Profit. You have this fantastic note on global volatility, which we'll talk about in a bit of detail. But I want to start with an overview from you, because we're speaking at the start of the Navratra season. You have these GST cuts coming in. Markets seem to have shrugged its shoulders and moved on. Why do you think so?
Well, actually, the good news is that a lot of the bad news is already in the price. A, our markets haven't been performing vis-a-vis their global peers. B, we've had the worst, I feel, of tariffs and tariff-related rhetoric, tariff-related bombast, which has been sort of played out. We've had sort of sobering noises in terms of people wanting to now talk about a deal that could happen. So we've gone through the full circle. We've had earnings disappointments, and now we have a situation where corporate balance sheets are as deleveraged as they've ever been. The private sector capex, in a sense, the greenfield capex is also beginning to start off as one of the things that was not there over the last several years. It was largely the public sector that was carrying the way forward. Keeping all this in mind, inflation is under control. Liquidity is very good. RBI is going all out to provide ample and more liquidity to the banking system. And in that context, I mean, really, I would say that it's a confluence of multiple factors, and especially the global tariff play out that's happened over the last several months. And I think paradoxically, providentially, whichever way you look at it, we could end up with one of the best deals, though that doesn't seem to be on the anvil in terms of case facts today. But I do believe that when the dust settles, India will emerge with a reasonably good tariff deal with the US. Apart from, of course, multiple bilateral FTAs and bilateral treaties with a whole bunch of trading partners, possibly this could mark the beginning of, and the final fling came in the form of some degree of fear amongst the IT majors, the H-1B issue, which may be the harbinger of other things to follow. Though the IT sector, I believe, is more beset with issues of how AI will disrupt it rather than many of the other issues regarding tariffs, etc. So in the short run, I think most issues have played out. We are still short of an all-time high, which the other markets have convincingly made, and especially the markets in the US, the Nikkei, for instance, the European markets are hitting new highs consistently and scaling new peaks. So from that perspective, India too should follow. The catch-up will be there. And with the GST moderation and the GST rationalization, etc., I mean, I can't think of a better set of circumstances. The FIs continue to be at the margin sellers. Their positioning is reasonably weak. Even today, they are far, far more short than they have been. So from that perspective, I think a contra rally is well and truly underway. We are about 1,000 points away from when we started at 24,200 or 24,300. We are about 1,000 points up from there, but we have some way to go is what I believe.
The contra rally is well underway, and Jake saying it is very, very crucial this time, because people really follow the path that you're setting. The portfolio you're talking about in this landscape, let me just come to that, the portfolio construction. And I noticed that pharma is something that you see as front and center, perhaps, if I'm not saying it incorrectly. Is this more of a defensive play, or is it untapped potential that you see?
Well, pharma, I think you could, you've put it better than I could have, which is front and center is pharma. It's even from an index weight reasonably low. It's still at a probably index weight of not more than 6.5%, and that was dominated by 2 or 3 stocks there. The ownership levels are very, very low in pharma still. Apart from which, I think the generics is actually a lifesaver for the US markets, for the US consumer. And I think, my own orientation is that of taking a contra bet in this from the perspective that people have viewed this largely as trading plays, and in many cases, event-led plays, like whether there are FDA approvals, etc. I think pharma has made, in the last several years, significantly more strides. There is an entire PLI orientation to some of the portfolios where the local manufacturing and the local self-sufficiency in areas like penicillin G, etc., is a step that the government has taken, which inevitably, as I see, they've already stated this, so this is not something that is completely out of the woodworks, that they will follow that up with minimum import prices. So domestic manufacturing of key inputs, key intermediates through PLI schemes is the way forward. That will supplement a lot of the generics and the manufacturing, the ecosystem that it supports, both from a manufacturing of generics and also other formulations, which I believe in the past we viewed these as not significant catalysts. But I think these are pretty major. And while they may be cozying up that India will do with China on certain trade aspects, but I think the Prime Minister's address a few days ago has laid to rest any doubts that we may have had about self-sufficiency and Atmanirbharta, as he calls it, that we need to manufacture what we want to consume. And if pharma intermediates, you don't want to be at the mercy of China. China recently has attempted to drop prices with a view to sort of shake up our industry. But if anything, it has only sort of added to the resolve that minimum import prices and other protection will happen where domestic manufacturing is being pushed. In addition to this, there are a lot of private equity-owned pharma portfolios in different parts of the world, which are up for grabs as these private equity folks come out. You must understand that many of these were acquired in low interest rate regimes 4 or 5 years ago. And the fund life may have played out, but more importantly, interest rates are up now. And therefore, many of these portfolios will be up for grabs. And I think as long as companies acquire this with prudence in terms of paying reasonable multiples only, I think Europe, especially Eastern Europe, will be a big play for pharmaceuticals, especially generics, as also, of course, the expansion of certain facilities that people may have in the US. So that's like a long explained explanation for why pharma. Apart from which, I think the other front and center, to use your phrase, would be the banking and financial services. I think there's going to be massive consolidation in the NBFC space, because the NBFC growth is largely predicated on leverage, and leverage comes with personal guarantees that most private equity stroke individual promoters do not want to partake with. Therefore, if there is no if there's no personal guarantees coming through, leverage is a problem, then effectively the growth in some of these NBFCs is a question mark. So these NBFCs will either consolidate with each other or, more importantly, consolidate into banks. Therefore, small
Jakes, good morning. This is Hiral Desai. That's a very interesting point that you make, where you're saying that your NBFCs will either consolidate with each other or consolidate with banks. If you could give us a few names and examples of what are the potentials that you see. I know you would not talk stocks, but just an idea of what is that size of NBFCs where you see consolidation happening, number one. And do you think that the FDI inflow, which is now expected to come back potentially, if that comes back, would it be BFSI as a sector which would then see this FDI inflow as well?
Absolutely. I think any country in the world where FDI is either encouraged or as FDI actually comes through, the BFSI is the first, if you will, destination for that capital. I see money coming into private sector banks, but to add to that point, I mean, when you say examples, there are NBFC portfolios that are being sold all the time. But recently, a company that got acquired by Ugro Capital, which is a first-generation entrepreneur-created NBFC, Ugro acquired a company called Profectus. It may have been at a multiple of 1.1 time because multiples in the NBFC space have also contracted. Now, Ugro effectively becomes a larger NBFC as a result of its Profectus acquisition. But this is the kind of play that there is. So there are multiple names in this space. I mean, names only illustrate, where deal making could happen, and that's not appropriate for me to talk about. But essentially, NBFCs to consolidate into each other or into banks, that's the theme. And foreign capital will come into private sector banks, which can effectively hasten the theme that I talked about, which is NBFC consolidation.
Jakes, I think the bus that we're missing is the AI boom. Look at what's happened with NVIDIA last night, and between NVIDIA and OpenAI and that whole, the sort of virtuous cycle or whatever you want to call it. That's the big push in the United States. India has perhaps missed that party altogether. Do you see a potential over there from the Indian context and the portfolio that you're talking about?
So I'll tell you what we may, in a sense, I think, I'm a great fan of what the IT services companies have created. And these companies have been actually created with a view to handling, services and, to put it loosely, to some extent, we may be uncharitable in saying labor cost arbitrage. But having gone past that, size and scale has been created, transitioning of systems from one to the other have been handled by them. Multiple geographies are being handled by them. Maybe the investment in pure product and pure research orientation, which multiple companies, of the Microsoft and the Google types have done, where they've invested, tens of billions of dollars in actually primary research, that may not have been done. But what that has essentially ended up doing, and DeepSeek has actually been a great champion of this, which is to say that maybe not the best product, but Me Too products are available where any LLM, large language models, are able to create a wonderfully sophisticated assistant for improving tasks which are done by rote. So if repetitive work is in a sense eliminated or made better with AI to that extent has now become, is almost getting commoditized in terms of the APIs or in terms of the agentic.
Very quickly, because I'm almost out of time with you. You started by saying you have a maybe more favorable view on IT companies in India than the market seems to have right now. A bit of a recovery, but nevertheless. Between AI, H-1B visa, do you think that there's scope there?
No, that's not the point I made. I think the point was that the disruption that AI can create is still, calculation in the works. And I think the IT companies have far more to lose with AI disruption than otherwise. But where India is not missing the boom, if you will, is a number of user industries using AI to make productivity higher and to make their efficiency, higher, if you will. So from that perspective, AI is still something that I think we are going to be using, and a lot of industries, a lot of companies are doing so. Maybe not IT services to the extent that we would like them to do.
Okay, fair enough. And Jay Kumar there, breaking it all down and making sense of very tough times. Thank you, Jay. It's always a pleasure to have you.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं। उल्टे हम भी जब विदेश जाते हैं, द बेस्ट ऐप टू यूज इज द एनडीटीवी ऐप।
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
The world's defining stage. Leaders, visionaries, decision makers, confronting the challenges of our time.
हमारा प्रयास होगा भारत की सेंचुरी सिर्फ भारत की नहीं बल्कि पूरी मानवता की जीत की सेंचुरी बने।
NDTV World Summit 2025, Edge of the Unknown, 17th to 18th October, only on NDTV.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
The best app to use is the NDTV app.
दुनिया भर में जब भी भारतीय मीडिया की चर्चा होती है तो एनडीटीवी सबसे पहले जिक्र में आता है।
मैं आपका बात से सहमत हूं। उल्टे हम भी जब विदेश जाते हैं, the best app to use is the NDTV app.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Good evening. Welcome to the big question on NDTV Profit. I'm Vikram Oza. Now, for over a year and a half, the Adani Hindenburg saga has cast this long shadow over India's markets and our regulatory systems. Yes, it started with a 106-page report by a little-known US short seller called Hindenburg that really wiped out more than $100 billion in market value and sent shockwaves through Dalal Street. But now SEBI has spoken. Its final report after a thorough probe and scrutiny is out. India's market regulator has dismissed the core allegations of stock manipulation and financial fraud against the Adani Group. Now the report is ruling that there were no related party violations, no siphoning of funds, no manipulation of share prices. Loans were paid back, disclosures were in order, and that's how the so-called smoking gun has fizzled out. Gautam Adani himself says this proves what he has always maintained, that the claims were baseless, an exoneration, which brings us to our big question this evening. Now that Adani is vindicated through the SEBI report, is it time to take on India's economic attackers? And that's what we are discussing tonight. We are going to be joined by political analysts, market experts, but right now we have Supreme Court lawyer Rayan Karanjawala, who's with us. Great to have you with us, Mr. Karanjawala. First, how do you... Yes, great to have you. But tell me, in your opinion, how are you viewing how the Supreme Court has handled this case? They appointed an expert committee. They sought SEBI's findings and then effectively allowed the regulator's word to stand. Did the judiciary strike the right balance in this case, according to you?
The Supreme Court has handled the matter with its usual sagacity. It interfered only as much as it needed to. It appointed an expert committee to see whether there were any prima facie violations, didn't find any, and then let SEBI, which is the regulator and which is the natural adjudicating authority, run its full course. And so it waited. As you know, in January 23, these allegations were made. Most of 23 and 24 and part of 25, SEBI went through all these allegations in detail, as you yourself just pointed out. And they have ultimately come to a simple conclusion that there was no wrongdoing on any of the allegations made against the Adani.
But Mr. Karanjawala, whether it was the Indian judiciary, you spoke about the Supreme Court and how it has acted in this matter. Whether it is the Indian judiciary, whether it's our market regulator, SEBI, whether it's our parliament or corporate India as a whole, everyone had to answer Hindenburg's allegations. Now the question to you is, shouldn't Hindenburg itself be made to answer? What is the way that that matter can be pursued now?
Well, I'm sure there are legal avenues open to the Adanis in case they choose to take it, which is that they can sue abroad and so on and so forth. But then you'll have to prove a very high level of, perhaps malice before you're actually able to take any real action against them. So Gautam Bhai's lawyers will, of course, advise him on what to do. At this juncture, I just want to make a small disclaimer, which I always do when I speak on this issue, which is that the group is a client of mine for the last several years, though, of course, they haven't consulted me in this matter. So I just thought I'd put it out there too.
Certainly, and we appreciate the disclaimer, Mr. Karanjawala, but shouldn't those responsible, I'm pursuing this matter as far as the allegations are concerned and what transpired because of it, the market saw a big crash, the kind of damage that was caused by that report. Shouldn't the people who put that report together and put it out face consequences for what seems to have come through in the SEBI report as baseless claims?
Well, I mean, at a sort of a emotional level, maybe you're right. But then, in order to face those consequences, certain actions will have to be taken either by SEBI itself or by the Adanis by way of a suit against them for damages. So those are things which are out there. You have to understand one thing, that, when you are as big as Gautam Bhai is in terms of business, then a lot of this actually goes with the territory. I saw it with the Ambanis also right in the beginning when they were coming up. Various applications were filed, various petitions were filed, many battles were hard fought on both sides, and slowly they went through their test of fire. This has been Gautam Bhai's test of fire.
It certainly has, and he has come through as well, and something that he has spoken about. But joining us on this discussion is also Tehseen Poonawalla. He's, of course, a political analyst, and, of course, markets regulator Sunil Subramaniam is with us as well. Tehseen, as far as you're concerned, when you look at this SEBI report, to you, does it prove that the attack on Adani was based more on perception rather than any real proof?
Good evening. Thank you so much for having me on the show. There are 2 or 3 issues that I would like to flag right away. Number one, that the entire Hindenburg report was based upon speculation, incorrect information, only to go short. So when the Hindenburg report came out, and I had of course gone through the Adani documents and the filings that the Adani group had done, I had publicly put out on X, formerly Twitter, that I am going long on the Adani group. And see what's happened. After making millions of dollars, the Hindenburg group has disappeared. Now, as the former speaker rightly said, Gautam Bhai is too big, the Adani group is too big to fail. But can we imagine the plight of those millions of small investors, medium investors who lost money only because somebody decided to be predatory, put out false reports and go short? Now, let me put 2 disclosures out. I am not against short selling in the market. I believe the market it's a mechanism of the market and there are inherent risks in the market. But can short selling be allowed based on false, incorrect reports disguised as investigative journalists so that you make millions of dollars? We now know from the SEBI investigation, all of those things that were put out were false. The shell companies, the insider trading. So can we allow a mechanism that allows for a false report to come out, completely damage a company's reputation? The people who pick that report then make millions of dollars on that report, and then they completely disappear as the Hindenburg group has disappeared. Can that be allowed? Such predatory tactics, can it be allowed in a market? And who suffers? The common man, the common Indian, the common investor. This is something that we as a nation need to